True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
As COVID-19 halted the economy, retail investors turned to stocks, looking to gain on the market swings. We'll explore this trend on a Bloomberg special report, Markets Melt Up, this weekend on Bloomberg Television.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. Tom and Francine from London and New York. So we'll have plenty more on the markets. We'll talk about U.S. China in a second. But first, let's get to the Bloomberg First Word News. In New York City is Karina Mitchell. Hi, Karina.
Fran, good morning to you. Bloomberg has learned that Goldman Sachs has agreed to settle that long-running case involving Malaysia's 1MDB wealth fund. Goldman will pay $3.9 billion. In return, Malaysia will drop all criminal charges. No word whether this will affect talks between Goldman and the U.S. Justice Department over 1MDB. Earlier this month, Bloomberg reported the bank is close to a settlement in that case. And China threatened to retaliate for the U.S. closing its consulate in Houston, and now it has. The U.S. has been told to shut its consulate in the southwestern city of Chengdu. It's a key U.S. listening post for developments in Tibet. Beijing says the move is a legitimate one and necessary to respond to U.S. actions. And it is getting more difficult to get a clear picture of the coronavirus pandemic in the U.S. The problem, testing shortcomings. Health officials warn that new infections may be significantly undercounted. The government's testing czar told Fox News that while 67,000 new cases may be reported each day, the reality is more likely about 200,000. And resorts in the Caribbean are reopening to tourism, but not to Americans. Tropical vacation spots across the region are giving Americans the cold shoulder. Authorities are afraid they'll spread the coronavirus. This week, the Bahamas will begin barring commercial flights and passenger ships from the U.S. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thanks so much. A Russian rate decision, no surprise here. Down they go on the rate, 4.25%. We'll have much more on that, but certainly this is something we're seeing within global slowdown. If you're ever so lucky, you come out of your academic grind and you publish a definitive book. It's 1 in 10,000. Elizabeth Economy did that with The River Runs Black. It was absolutely definitive on the environmental chaos of China. And then she followed it with a hat trick, finishing up with the third book, The Third Revolution, which was immediately definitive on the fragility of the Communist Party in China and the fragility of the new experiment of President Xi. Elizabeth Economy joins us now, the Council on Foreign Relations. Elizabeth, with this tit for tat, what is the strength of the Communist Party right now? What is the leadership quality, the leadership strength of President Xi?
Thanks, Tom. Great to be here. I think, look, the Chinese are under enormous amount of pressure, the Chinese leadership, even with a small economic rebound, somewhat unexpected in the second quarter. They're facing rising unemployment. There's international opprobrium over the actions that they've taken in Hong Kong, over their assertiveness in the South China Sea. The trade war is still ongoing with the United States. So Xi Jinping is feeling battered to some extent. He's getting it on all fronts. Even his Belt and Road Initiative, his flagship foreign policy initiative. Many countries are requesting forgiveness of the debt. So a lot of pressures on Xi Jinping. On the other hand, when you look at the way that China has managed the pandemic now, 7-8 months out, and you compare it to what's happening here in the United States, Xi Jinping looks a lot better. And so I think he's gaining some strength from the fact that China's recovery is on its way, that they're managing their outbreaks fairly well, and then look at what's happening in the United States.
Elizabeth, the game theory here is simple. I guess as to an amateur, it's a game of chicken. And at some point that unravels. How does the tit for tat unravel?
I'm puzzled, quite frankly, at what's going on right now with U.S. policy. I've been a supporter of the Trump administration's effort to sort of recognize the new challenge that Xi Jinping poses. I call out China for all of its malign activities. But at this point, it seems as though the punishment is the end game. We're simply seeking out areas to punish or to retaliate against China. And there doesn't seem to be any kind of long-term strategy. So there is no end point to a tit for tat in that context. If you don't know what you're driving toward, right, then the punishment becomes the end. And so I'm concerned, that we seem to think perhaps in the past month, we've had 4 major speeches from 4 of the top officials in the Trump administration on China. We've had, this range of, punitive actions, indictments of hackers in China, the closure of the Houston consulate. We've had sanctions on Chinese companies for using forced labor in Xinjiang, withdrawal of Hong Kong special economic status. It goes on and on and on. Maybe this is their effort at shock and awe, right? That somehow, our overwhelming firepower and our dominance is going to sap China of its will and force them to succumb to U.S. demands. That's clearly not what's happening. And so I'm a little puzzled as to where the Trump administration thinks that these kinds of actions are actually going to take us.
But Elizabeth, so that means that it could actually escalate quite quickly, or is there, does the Trump administration kind of, want to, do something, but then at the end of the day also realizes that it can't escalate too quickly because then everybody gets damaged?
There does not seem to be anybody pulling the brakes on the administration at this point. There's no diplomatic engagement. We have no ongoing set of consultations with the Chinese at this point, save the trade negotiations. And we know that President Trump just in the past 24 hours said he doesn't care as much about the trade deal as he used to. So even that, his sort of pride and joy, and now is sort of tossed into the trash bin. Again, I'm concerned that we don't have anyone in this White House who's saying, hey, wait a minute, where are we going? What are we actually yielding from all of this? And I think that's a question the administration doesn't seem to be asking. What is the behavior that we are actually deterring on the part of China? Again, it seems that we're just punishing, retaliating, without any sense of, and here's how China's behavior is changing or has changed as a result of our actions. So I do see this continuing. I don't see any evidence that the Trump administration has an end game in sight.
Elizabeth, is this then a longer term thing? Is this, over, world supremacy in the next 10 years?
Well, I think the idea, sort of the challenge that China poses, as long as Xi Jinping is in power, is a broad one, and it does span economics and military and ideology and norms and values. So there is going to be conflict, but it's really about how you manage the conflict. And I would imagine that a new administration, assuming it's not the Trump administration for another 4 years, is going to take a step back and is going to adopt a different approach. Doesn't mean that, say, a Biden administration will not be equally tough on China, will not seek to push China in different ways. But it does mean that we will, I think, re-engage with China, look for areas of common ground, put the United States back into multilateral institutions where we can have greater influence. I think we'll have a rethink of China policy.
Liz, an unfair question, but this is what you do. You fly into Hong Kong, you fly into Singapore, you get in the Uber and head downtown to Global Wall Street, and they're going to sit in a room and you're going to hear a pin drop when they ask you the question, what should we do in Hong Kong? Should the business and finance operations of Hong Kong begin to make plans for Singapore?
I think it is a difficult question, and I'm torn, quite frankly, between my enormous sympathy for the people of Hong Kong and desire not to inflict any greater pain on them, and the kind of pain that would come from a real withdrawal of multinational presence in Hong Kong. And my feeling is though China is transforming Hong Kong into just another Chinese city. And so to the extent that these financial institutions and others are dependent on the rule of law, on independent judiciary, on transparency, all of the sort of norms of governance that companies have come to expect from Hong Kong, I think they have to understand that those are probably lost. And that's the determination that they're going to have to make.
Liz, thanks so much. Elizabeth Economy with the Council on Foreign Relations. I can't say enough about the third revolution, Xi Jinping and the new Chinese state. I read it cover to cover, every single word. Coming up with the pandemic, we love to end our Friday strong with Andrew Pekos. He's with the Johns Hopkins University Bloomberg School of Public Health. Stay with us. Futures, -11, Dow futures, -62. This is Bloomberg. Good morning.
Over the last 30 years, I've managed through a number of crises myself, but nothing I've ever seen has ever been quite like the crisis we have now. I want to talk to CEOs and see how they're living through this crisis. Who is going to really manage their company in a way that people will remember it? That's what I want to know. This is Leadership Live.
The China consumer has become so important to many U.S. brands and small businesses because that's where they see growth and the ability to benefit in the post-COVID environment.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Joining us now is Dr. Andrew Pekos, Johns Hopkins University Bloomberg School of Public Health and professor and virologist. Andrew, thank you so much for joining us. I think the CDC has just laid out some guidelines on school reopenings in September. What do we know about how COVID-19, passes through young kids?
Yeah, so, we still are learning a lot. What we do know is that the very young, so let's say under the age of 10, seem to be suffering from relatively mild disease, although there are some instances of very severe secondary sort of syndromes that occur in that population. But for the most part, infection isn't as severe if you're under 10. What we don't know is how well that population of kids is transmitting the virus to others, because we know from other diseases like influenza that the very young are actually good transmitters of virus to their teachers in school, to their parents, to other household members. And that's the information that we're missing right now. And that's really critical for opening schools, particularly schools for elementary age kids.
Dr. Pekos, I looked at the statistics today, and particularly the log slope, where slope matters. And California is actually pretty good on a relative basis versus the disaster that is Florida and Texas. Is it fair to combine Florida and Texas together to aggregate their data into what's to come on cases becoming deaths?
Yeah, this disease has shown us that it's really about local spread and local transmission and local cases. So I try not to encourage people to collapse too broadly across the country or in other states, because it really does matter what's going on in certain localities. I think you're absolutely correct in terms of there are some more worrisome numbers coming out of Texas and Florida and some other states, actually. But again,
right.
Even worse than that, though, is the large number of states that are showing beginnings of increases in cases. And that's telling us that there's a systemic issue going on across the country in terms of how we're intervening to keep the virus levels down.
Yeah, I totally see that. I mean, Alabama and Mississippi having a tough week of it as well. If that's the case, what is the experience we've learned from New York to help Florida?
Well, massive testing, very solid lockdown capabilities in terms of being able to limit the spread of the virus, and waiting until those virus cases get down to manageable levels. And there's a number of guidelines out there. One of the ones that the CDC likes to put forward is this 5% positivity testing. When you get down to those levels, then other interventions like contact tracing can be put in place effectively, and that will then be the tool that will keep infection levels down. But contact tracing won't work when you're having 60,000 cases across the country come through, because that's just too much of a strain on that infrastructure, and they can't be done effectively.
Andy, we spoke to the chief executive of Roche yesterday, and he was saying that he's worried we're testing too much and there are just not enough kits. So he suggested, and he's one of the manufacturers of the kits, that we only, test people with symptoms. Would that be enough to get a handle of it?
So it's an important question. If you're getting tested and you don't get your results for 4, 5, or 6 days, then the testing is almost irrelevant, because you're going to have to be in quarantine for that period of time. And the current CDC guidelines say that you should be quarantined for 10 days after experiencing symptoms. So we have to find a way. If testing is going to be limiting, we have to find a way to use it more effectively. And it may be that we need to scale back who we're testing to speed up the time in which those results are coming through. One would have liked to have seen by this point in time that the manufacturing capabilities and the distribution capabilities for all these tests would have been scaled up so that we can handle a larger amount of testing. But it certainly seems like we're back to the beginning of this pandemic in the U.S., where we're also having a supply chain issue when it comes to the testing.
Do we, I know there are new guidelines about reducing the time that someone needs to stay in quarantine. Is 10 days enough?
It certainly seems like the data that's coming out now is suggesting that 10 days is a very reasonable time for quarantine. The tests that we're using to tell if people are infected are so sensitive that they detect even small amounts of the viral genes, the viral RNA. And it's clear that when we detect those small amounts of RNA, that's not enough virus for that person to spread it to someone else. So the new CDC guidelines reflect the fact that what we're really interested in when we're quarantining someone is the period of time that they can transmit the virus. And going from 14 to 10 days still maintains a high probability that we're keeping people away from other people during their transmission times, but then it allows them to get back into their normal activities a little bit faster when they pose very little risk of spreading the virus.
Great, Andy, thank you so much for joining us. Andrew Pekosh there of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. Tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Coming up, the Intel chief executive, Bob Swan. That conversation, 11:30 a.m. in New York. We'll talk about tech, we'll talk about Intel, we'll talk about valuations. That's 4:30 p.m. in London, and this is Bloomberg.
opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff and it'll take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash with Karina Mitchell. Hi, Karina.
Morning to you. Shares of Intel are falling, the company revealed after the bell that a new chip production process suffered another delay. That news boosted shares of rivals such as Advanced Micro Devices and Taiwan Semiconductor. At issue is a new method for cranking out smaller, more powerful chips. And it is the latest sign that the coronavirus is wreaking havoc in Hollywood. Disney has canceled the August release of the widely anticipated film Mulan. It also delayed future Star Wars and Avatar movies by 1 year. Meanwhile, the largest U.S. theater owner, AMC, has delayed its reopening until mid to late August. And about 400,000 airline workers around the world have been fired, furloughed, or told they'll lose their jobs because of the virus. That's according to Bloomberg calculations. The biggest losses have been in North America, Europe, and Asia. Meanwhile, job losses in related industries such as aircraft makers, airports, and travel agencies could reach 25 million. And that's the Bloomberg Business Flash. Fran.
Thank you so much. Now, Bloomberg has learned that there's a settlement in the case involving Goldman Sachs and Malaysia's troubled wealth fund, 1MDB. Let's get the details from our Kuala Lumpur bureau chief, Judith Ho. Judith, I mean, the numbers that we understand are being, touted about are bigger than what we thought. How surprising is this?
I think the sum is very surprising, especially because we're talking about $2.5 billion that's in cash. And that's the headline number, the $3.9 billion, that also includes at least $1.4 billion that's going to come in the form of seed assets that is going to be returned to Malaysia. I mean, the number itself is surprising, but it does include having Malaysia drop all charges basically against Goldman. So I think that was the deal that was struck, that it's going to be a full deal.
So if this is the number that then gets, said it's true, gets confirmed, Judith, is that it? Is Goldman Sachs no longer implicated in this?
So yes, the finance ministry has actually confirmed these numbers, the 2.5 billion total amount and the 2.5 billion cash amount. Those have been confirmed by the finance ministry. For the unit of Goldman, the charges will be dropped. In the finance ministry statement, it does include a line that says that this settlement is not going to have any implication on other 1MDB charges, including the ones against Jolo, the fugitive financier Jolo, and also other parties. In the statement, it also talks about how this deal basically cements the understanding that 2 Goldman Sachs employees have pleaded guilty. The statement doesn't name these people, but I think that signals that it might not be, the deal is against the bank's unit, but there might still be other parties involved in the case.
So Judith, when are you expecting this to actually have, how quickly can this be confirmed?
I'm sorry, for the numbers, is it?
Yeah, for the numbers, I mean, when are we going to, I mean, this is a 3.9 billion settlement. I mean, is this now a completely done deal?
Yes, it is completely a done deal. The finance ministry has okayed it. They have already held the signing, and the government representatives have actually been here all week to hash this out. And just today, they basically signed it. The deal is done, and that's it.
I mean, does this have, this also basically is the acknowledgement of Goldman Sachs of the misconduct of two of its former employees. Will there be legacy issues on how Goldman Sachs will be seen in the region?
I think as it stands, Goldman doesn't have a huge presence in terms of deal making in Southeast Asia, especially not in Malaysia. It is hard to say right now whether this means that Goldman is going to, whether this is going to pay way for Goldman to increase its presence. But as it stands, they don't have that big a presence here.
All right, Edith, thanks so much. Bloomberg's Kuala Lumpur Bureau Chief Edith Ho. This is what the markets are doing right now. Now, futures are drifting after being a little bit lower in the last hour. Futures drifting because they're worried about this escalating China-U.S. tensions. They also worry that the recovery in the U.S. may actually have stalled. The 5-year Treasury yield touching an all-time low before bouncing back. Gold actually trading near 1,900. So you can see currently at 1,890 an ounce. That's close to an all-time high. And the dollar extending the weak slide. If you look at offshore yuan, it's dipping, and core European bonds are actually falling after the U.S. Treasuries turned lower. Now, coming up, they'll be speaking more Bloomberg surveillance with Richard Haass, the Council on Foreign Relations Presidents. That's at 7:30 a.m. in New York. That's 12:30 p.m. in London. And that will be brought to you by Tom Keene, Jonathan Farrer, and Lisa Abramovich, because up next is more Bloomberg surveillance, simulcast on Bloomberg Radio and television. That's coming up in just a couple of minutes. They'll talk tech stocks, they'll talk the economy, they'll talk Treasury, and of course, stimulus. This is Bloomberg.
Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
I think the V-shaped recovery is very hard to see with continued virus cases.
When we talk about a correction, at this point, we're talking about a normal amount of turbulence in the equity market, which would be about a 10% correction.
Fiscal stimulus is great, and it kind of gives us that shot in the arm and it buys us time to get there.
That's what the U.S. economy needs. We're basically right at the edge of a huge fiscal cliff.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance with equity futures negative. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Tom Keene, once again, it's about tension between the United States and China. We get the tit for America's tat.
You know, China chooses Chengdu to go after. We just spoke with Elizabeth Economy of the Council on Foreign Relations. You know, John, her book is The Third Revolution, and you wonder what the fourth step is going to be here. Who acts next in this back and forth?
Tom Keene, the administration has been dancing around the issue of the trade deal that was announced back in January. The president has stopped dancing around the issue. It means much less to me. He repeated that, Tom, about 3 times in the news conference yesterday, and I wonder how that message evolves in the coming weeks and months.
Well, into the Friday, it's extraordinary. You know, I thought it would be a lazy Friday, John, and I was wrong. Let me give you 2 quick ideas. You know the Donnybrook of the Republicans in Washington. That'll be part of the ballet, backstopped against China as well. And then we had one statistic come out moments ago, John, which speaks to this summer of 2020. Honeywell is without question one of the best run companies in the world. Their organic revenue growth was negative 18%. You don't need to know anything else, John.
We'll get the earnings a little bit later in the program. Let's get to the market data. Equity futures slightly negative, Lisa. Gold very much in focus, approaching a record seemingly at one point this morning.
Yeah, and it has to do in part with the weakening dollar. It also has to do in part with very negative real yields in the United States. But this has to do also with the European story, and we got some better than expected European data. Interesting to see at 9:45 a.m. whether we get something similar out of the U.S. July PMI data. In the U.S., we're seeing the economic surprise index tick a little bit lower. 1 p.m., Baker Hughes rig count. This will be interesting because it has fallen for 19 straight weeks, but is expected to increase for the first time since March. And then at 3 p.m., President Trump is expected to sign orders on lowering drug prices. That isn't necessarily that interesting in and of itself, but perhaps he will comment on the deepening rift within the Republican Party on extending the unemployment stimulus.
The tension is there for all to see. Let's get to the price action worldwide and cross assets, shall we? Equity futures this morning, just a small gap lower. We've seen this a couple of times this week. Tension between the United States and China, gap lower. Tension grows older. We start to bounce back a little bit. We're down by 0.2% on the S&P 500. In the bond market, yields at a single basis point to 0.59%. And after a week of euro strength, euro dollar coming in 0.1%. Euro dollar 115.88. Let's bring in the first guest of this morning, shall we? Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. He joins us now. Peter, fantastic to catch up with you. Would you believe it that Europe comes out of this week looking clean, looking good compared to the rest of this world?
Yeah, and what a difference a decade makes, I guess, because obviously Europe was very slow to respond after the last crisis in 2008. And it suffered a series of major hurdles over the years that followed that financial crisis. But it's getting its act together from a policy perspective. And as you say in your report, the economy is recovering quite nicely from this downturn.
Peter, Tom Keene in New York, good morning. You've got one of the coolest degrees in the undergraduate world, the geography degree, folks, from the London School of Economics. Is absolutely legendary. Tell me the geography of Chengdu. How far is Chengdu emotionally, politically, from Washington and from Beijing?
Hi, Tom. That's a great question. My geography didn't really stretch to that, but I think this is a reflection of just the growing tensions, and so far you're getting one action matched by another, but it looks as if these tensions, at least in the short term, are going to increase. This is one of the factors I think that will probably wear on markets as we move towards the U.S. election, at least.
Peter, what's the calculation and how it affects equities? Because yesterday, tensions were also rising. The day before, also rising, and yet it wasn't affecting equity prices. Why today, and what going forward will be sort of the trigger point for U.S. stock value valuations?
I think it's a very difficult thing to measure the economic impact, because of course we don't know entirely what this means in terms of future trade tensions specifically, which would have a more direct effect on markets. But I think it's one of these things that just increases the risk premium, just the degree of uncertainty. We have had, of course, a tremendous run in equity markets as investors are looking through what is likely to be the worst economic downturn for 60, 70 years into a strong recovery. We've already seen that happening, and we've had the boost from very strong policy stimulus. And I guess now the reality of what's likely to still be quite a tough geopolitical environment, which indeed was an issue that really bore down on equity markets in the first half of last year, is likely to come back. So I think this is a bit of sort of reality coming back to investors as they reassess the risks over the next few months.
Peter, do you think they'll continue to look through the economic data if it looks weaker from here? Are there signs that we're losing momentum here in the U.S. economy, or do you think we're rolling over again?
Yeah, I think there is a bit of a loss of momentum. We're seeing it in the labour market. Clearly the rebound from in Q3 versus Q2 is going to look very V-shaped, and this is true in pretty much all parts of the world, as you start to get easing of lockdowns to varying degrees, and an improvement from a very, very weak base. But I think the question really for investors is going to be, what's the sort of run rate after this? Bearing in mind that most economies are not going to get back to the levels of GDP they were seeing at the beginning of this year until late next year or into 2022. And I think that sort of more cautious reality, together with the geopolitics that you've mentioned, is really going to be one of the constraints on risk assets over the near term.
Well, Peter, you're constantly talking to the buy side and investors, so give us some insight into those conversations. Do you get the sense that anemic growth, so long as that growth is positive, that is sufficient for risk assets?
It is, partly because, and you mentioned this just earlier on, real interest rates have turned increasingly negative, and that's a positive for risk assets. There's a lack of alternatives. Forward guidance has meant that nominal rates are likely to remain at zero or close to that lower bound for a very long time, and people are struggling to get a return. So although the absolute returns may come down from here, there is a willingness, I think, to look more positively at risk assets like equities. And actually, interestingly, for the first time for a very long time, there's, amongst global investors, a more optimistic view of Europe specifically, which has dealt better with this crisis, but was also, I think, surprised on the upside in terms of the coordination of the policy response.
I mean, Peter, the idea of index versus active may be too fancy for you, but maybe we can just say the level of diversification now within our equity holdings. Do you want to be over-diversified, spread it out, or do you want to make more focused bets into late 2021?
Oh, I think that, investors, global investors, and certainly dollar-based investors should be looking at diversifying more. We do believe that the dollar is likely to weaken further over the coming years as interest rate differentials narrow and as deficits rise in the US. So that's one reason for diversifying geographically. But also bear in mind the last cycle, the last decade, was very extreme in terms of differences across geographies, particularly in equities, massive outperformance of the US. That was justified because the US outperformed the rest of the world in terms of profit growth, largely because of its dominance in the technology sector. It still has dominance in that sector, and that sector is still going to be very important. But other areas of the world are catching up a bit. They're becoming a little bit more growth-orientated themselves, not least of which is that's true in Europe. You know, when the crisis started a decade or more ago, banks in Europe were a quarter of the index. That was the epicenter of that crisis. They now account for about 7%, about the same weight as the technology sector. So Europe and Asia are getting a little bit more exposed to growth and technology themselves, and I think that justifies more geographical distribution, and I think probably more focus on alpha opportunities and less on beta, so more on stock picking and less on indexes.
Peter, given the fact that you believe that investors are underinvested in Europe, how much could it outperform U.S. equity indices over the remainder of the year?
Well, if we look out over 12 months, and if we look at things in common currency, in dollar terms, we would expect Europe to be, from these levels, going up around 13%, where we've got a relatively flat return for the S&P. A part of that is the difference in the dividend. Europe has a higher yield than the US. Part of it is the currency. We actually have the euro going to 125 over 12 months against the dollar. But some of it is a bit of a catch-up in valuations. Europe still has a valuation gap, a lower valuation than the US market. And we think with this narrowing risk premium, with this increased confidence in Europe, that will narrow a little bit from here.
Peter, great to catch up with you. Send our best to the team, won't you? Peter Oppenheimer there of Goldman Sachs. Thank you very much, sir. Tom Keene, we've got to talk about the polls a little bit later in the program as well. Did you see the poll out of Florida?
Yeah.
From Quinnipiac?
Was quite thunderstruck by that one.
The president at 38%, the former VP Joe Biden at 51.
And what's absolutely fascinating, John, to that, and this is maybe away from our remit, but I'm going to go there right now. All of these polls color the Biden response from doing something, but just as importantly, John, maybe if the Republican Party's having trouble with stimulus, you just sit quietly, and maybe that's what we're going to see to the Sunday talk shows.
And Tom, I wonder if they color the response in China towards China as well. Coming up next on this program, coming up later, Richard Haas of the Council of Foreign Relations from New York City this morning. Good morning to you all, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Up a little bit later, we'll catch up with Richard Haas. Before that, we'll catch up with the EU Commissioner on Europe and how Europe sits between the United States and China. From New York, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. Bloomberg has learned that Goldman Sachs has agreed to settle that long-running case involving Malaysia's 1MDB wealth fund. Goldman will come up with $3.9 billion in a combination of cash and 1MDB assets being returned. In exchange, Malaysia will drop all criminal charges. No word whether this will affect talks between Goldman and the U.S. Justice Department over 1MDB. Earlier this month, Bloomberg's reported the bank is close to an agreement in that case. Meanwhile, China has struck back. It's ordered the U.S. to close its consulate in the southwestern city of Chengdu. That's in retaliation for the U.S. decision to close the Chinese consulate in Houston. Chengdu serves as a key U.S. listening post for developments in Tibet. China says its action is a legitimate one and a necessary response. And President Trump has given in to worries about the coronavirus. He's canceled his Florida nominating convention. That was going to be the biggest event of his re-election campaign. Florida just postponed a record number of deaths from the pandemic. The president says he didn't want to take any chances. And in the UK, the lockdown eased off and retail sales soared last month. Sales volumes, including fuel, were up almost 14% in June. That's the most since records began being kept in 1996. Sales are now approaching their pre-lockdown levels. And it's the latest sign that the coronavirus is wreaking havoc in Hollywood. Disney canceled the August release of its widely anticipated film Mulan. It also delayed future Star Wars and Avatar movies by 1 year. Meanwhile, the largest U.S. theater owner, AMC, has delayed its reopening until mid to late June. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. More to come.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Basically right at the edge of a huge fiscal cliff with the expiration of the $600 a week unemployment compensation benefits at the end of this month. And if that's not, replaced by something significant soon, the economy is actually going to be weaker than people anticipate.
Bill Dudley there, the former New York Fed president, on the fiscal debate down in Washington, D.C. into the weekend and out to next week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. In your equity market this morning, this Friday morning, we shape up as follows. We come in 9 points on the S&P 500 after some weakness in big tech yesterday. Some negative follow-through for the S&P. We're down 1/3 of 1%. In the FX market, the euro slightly softer here, down 1/10 of 1%. Euro dollar 115.85. And as we get a bit more tension between China and the United States, another reason for a 10-year to stay pinned in and around 60 basis points. Tom, your yield, 0.58%.
A little bit of economic data earlier from Europe, which gave a little lift to yield as well, but it's a nuanced market here on a Friday. He is the most interesting politician. He's a former prime minister of Latvia, providing great leadership out of the financial crisis. Valdis Dombrovskis brings economics and physics to his duties as a European Union commissioner for financial services, and he helps us pick up the debris 1 week on from exhaustive meetings in Europe. Valdis, I have to broaden out the conversation right now to how Europe approaches these new tensions with the United States, the new tensions with China. Is there a European foreign policy?
First of all, as regards the international tensions, including international trade tensions, EU's policy has been very clear. We are supporting and defending a multilateral rules-based system. And this is an approach which we are taking in the negotiations with US, with China. That's why we are not supportive, for example, of unilateral moves of US in the area of trade. But at the same time, we share a number of concerns regarding China, including questions on intellectual property rights, forced technology transfer, reciprocity in our trade and investment relationships. So there are a number of issues which we think to address, but we think those should be addressed while respecting international rules.
How do you adapt then and adjust to the Secretary of State on his tour through London and through Denmark and then back over to San Francisco this week? The assertive tone of the Trump administration, how do you and Ms. Vestager and the rest, how do you adapt to that in Europe?
First of all, as you know, EU and US had its trade tensions. We managed to reach an agreement avoiding further escalation, and currently we are building on that. So one can discuss that the tone is assertive. But at the same time we are negotiating, and we have reached a degree of agreement. Well, we know that initially US were taking unilateral actions, like unilaterally raising tariffs. We were responding in kind, in a proportionate way, but at the end of the day we avoided further escalation and reached agreement on which we can now build.
Commissioner, we've heard a lot from Europe about the multilateral response. Can we talk about concrete steps? You yourself have talked about the asymmetry in market access between Europe and China. You talk about reciprocity as well. Can you talk to us about concrete steps? What are you doing to get the Chinese Communist Party to change?
Well, actually, we are currently negotiating with China investment agreement, and we are currently preparing the next EU-China economic dialogue to discuss exactly these issues, and we hope that we will be in due course actually able to conclude our negotiations on investment agreement, and the issues we are discussing with China in these negotiations are exactly the questions of access to China's market, reciprocity, investment conditions, non-tariff barriers. So all these issues are on agenda in our investment negotiations with China.
Commissioner, how much is the European Union working with the United States as tensions increase with China in both regions?
Well, as I said, we share a number of concerns of US, and we have similar concerns, and definitely we are working with US to see how most effectively to address these concerns, but we think that it should be done within multilateral framework, within the framework of World Trade Organization. Yeah. We know that we need a reform of World Trade Organization, and we are willing to cooperate and coordinate our actions on this with US, but what we are saying is that one should refrain from unilateral actions, because it just escalates the tensions further, and at the end of the day negatively affects international trade and negatively affects global economy.
Commissioner, thank you for addressing the news at the moment, particularly this morning. If we can get you to address the news of this week for Europe, which was a massive step forward for the continent and fiscal integration, can you just walk us through next steps from here, when we can expect the debt issuance from the European Commission over the next several months, when that money will be raised?
Well, indeed. So early this week, EU summit decided on the next 7 years EU budget, so from 2021 to 2027, and on the EU economic recovery package worth 750 billion euros. So this is a major step forward. So we welcome this this agreement of the summit. Well, there are further procedural steps. Currently, we are starting negotiations with European Parliament, because also European Parliament needs to agree to this multi-annual budget and the recovery plan. Yep. In any case, we from European Commission side, we consider that it's important that negotiations are finalized swiftly, so that the next multi-annual EU budget and recovery plan can start acting as of January 1st next year, and that's when European Commission also would start this common issuance of debt in order to finance EU economic recovery plan. Even though it must be said that some elements we will be going to markets already this year, because here we are talking about economic recovery plan. Yeah. But we took lots of crisis measures in previous months, including, for example, 100 billion euros SURE program to support employment and unemployment mitigation in EU member states. And we will be going to markets already this year to finance this program.
Commissioner, thank you for your time this morning. We really appreciate it here at Bloomberg. Valdis Dombrovskis there, EU Commissioner for Financial Services. Coming up on this program, coming up next, Richard Haas of the Council of Foreign Relations from New York City this morning. Good morning. This is Bloomberg Surveillance.
Okay, ladies and gentlemen, new order placed for Japanese yen. I'm looking to buy Japanese yen at the price 106,349. 106,349. So order placed to buy at this price.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Bravitz. I'm Jonathan Ferro. This Friday morning, here's your price action cross-asset worldwide. Equities on the week, slightly positive on the session, slightly lower, down 11 on the S&P. We're off by a third of 1%. We're on record watch in a gold market. We settled down just a little bit in the last hour. Crude positive, 0.5%. WTI back to $41.29. And there we are in the bond market, Tom Keene, up a single basis point. Yeah. Nominal yields just very, very sticky over the last month, in and around 0.6%.
Yeah, Europe to the rescue today, John. We had better economic data out of Europe.
We just opened new position on Japanese yen at 106,349.
Tom Keene complained that he gets up really early, but let's be clear, Tom, you don't sleep anyway because you text me on the weekend at 3:30 in the morning.
That's true. That's true. Well, you know, that's how we roll.
And you choose to do that on the weekend.
That's what we do. We're reading it on the weekend and trying to get smarter.
That's what you're doing. Okay.
We'll try to do that right now. We've got lots of international relations going on, and we'll get to the really shocking stimulus debate in Washington as well. But right now, without question, our conversation of the day on what's going on with China and with the world at large. Richard Haas has written my book of the summer, It's the World, and I'll make real clear, take it and throw it at any smart mouth college kid you know and beg them to at least read the first 150 pages, which is a tour de force on the Western civilization we've all forgotten, or quite frankly, we never took. Ambassador Haas joins us now from the Council on Foreign Relations. Ambassador, in your book, The World, you write about war between countries. Are we now at war with China?
No, Tom, we're not at war with China, but the entire trajectory of this relationship has changed compared to what it was. For what? The United States and China built a relationship 50 years ago. We originally worked together against the Soviet Union. Then our economic interaction essentially became the foundation of the relationship. That economic interaction has now become a source of friction. But what you're seeing, particularly on the American side, is a real ramping up rhetoric against China at a time China's becoming more assertive in its foreign policy. We're not at war, but but this is a relationship that seems to have lost any positive dimension, any rationale, and increasingly it's marked by confrontation.
Ambassador, I want you to go to a time and place long ago. James McGregor Burns was great about this, about how we developed the State Department, how we developed a foreign voice as Americans. Please comment on the tone, the discourse of our Secretary of State this week. To me, it's original, really, within the 20th century and this new century. Is it?
I'm hard-pressed to find a parallel, Tom. I hear where you're going, and I'm sympathetic to what you're saying. Our chief diplomat is going out of his way, not just to be undiplomatic, there's a time to be that, but to be publicly provocative, insulting his counterparts in China. Essentially yesterday, in a speech at the Nixon Library, almost delegitimizing the current leadership of China. And essentially, it came very close to calling for regime change in China. The parallels between his approach to Iran and the approach we heard yesterday in China, I thought were pronounced.
Okay. You know, Richard, this is really, really important. The Peace Hotel over in Shanghai yesterday on Twitter put out a photograph of their claimed British room where Henry Kissinger, I believe, slept the night before he went to Beijing to change history. Are we giving up all that was accomplished in the early 1970s?
It's too soon to say that. We don't know how much of this is tactical, political, to be blunt, in our own context in the run-up to November. We'll have to see what happens. But this is extreme. This is the idea, by the way, this is ironic, that the speech took place at the Nixon Library. Nixon was willing to find common cause with China despite all of our fundamental political and social differences. Yesterday, the Secretary of State ignored the potential for the United States to work together despite our political differences and instead harped on those differences. It's as if he's looking for a fight with China. And I think, again, this relationship, anytime you have a relationship between a rising power and existing power, we know that this is difficult. It calls for really subtle, deft statecraft on both sides. Whatever else you want to call yesterday's speech, I would not use adjectives like subtle and deft.
Maybe that's the tactic. I don't know, Richard. Something else I don't know is, what is the strategy? What is the strategy at the moment? Can you identify what it is?
No, sir. Traditionally in foreign policy, the strategy is to change the external behavior of other countries. Now, if our goal, we could have legitimate goals about changing China's approach to trade. We could have goals about getting them to ease up in Hong Kong or not to deal with the Uyghurs the way they are, to stop with their unilateral claims in the South China Sea. All of those would be within the traditional realm of a foreign policy. That would be a strategy, and we would work with our allies to bring it about. Instead, in yesterday's speech, you have the Secretary of State berating our allies, including Germany, and again, not making clear what exactly it is we want China to do that is in the realm of foreign policy.
Richard, Tom Keene started this asking, are we at war with China? You said no, that's a stretch. But is that the outcome that we're getting toward? I mean, what is sort of the trigger points here and the possible tit-for-tat escalation that could be a worst-case scenario?
Well, we've had now the tit-for-tat. We close Houston, they close Chengdu. I would think the most dangerous thing for the next few months would be an incident in something like the South China Sea. China has unilateral claims. We correctly do not accept their maritime claims. We're sending ships to the region to demonstrate we consider these waters to be international. The idea that you could have some type of a military incident that could then potentially escalate, I don't think is out of the question. So for me, the next few months, some type of a military incident. And then the question is, do these two countries have the ability to manage it? Do they have the desire to manage it? That I would put, that to me is the greatest near-term danger.
Richard, do you buy that the Phase 1 trade deal is still on?
Well, it's on paper. It's never been close to being implemented. To some extent, that's because of the context given to the coronavirus. It's on in paper. There's no movement whatsoever towards a Phase 2. I think that would only change if Mr. Trump were reelected. And I think suddenly my guess would be that you'd see a slight winding down of this hostility towards China if he were reelected. There would be a desire for some type of a deal that would increase U.S. exports to China. That's been the centerpiece of his foreign policy, to essentially try to bring about trade deals that increased U.S. exports. But for the time being, nothing's going to happen. The Chinese have zero incentive to implement the Phase 1 deal.
Ambassador, as we wrap up this conversation, I think you've touched on something really, really important, just reflecting on everything you've said. Typically, diplomacy is surgical. You really think out what you're doing and work out the whole range of responses the other side might respond with. And I have been asking that question this week, just how surgical the approach has been from this administration. And I think the one thing a lot of people are worried about is the prospect, the scope for an accident in some realm of confrontation with China. Where do you see that potentially happening?
Well, you're right. First of all, this is anything but surgical. Surgical would have been, for example, rather than closing the Houston consulate, we might have asked quietly and privately for certain diplomats to leave. We might have placed some restrictions on certain students. Closing a consulate is the opposite of surgical. That's sledgehammer material. I think you'll see heated rhetoric for the next few months. I think two things to look for. One, I already mentioned, a military incident. The other is, I wouldn't be shocked, given Secretary Pompeo's speech, if you saw some broad sanctions against members of the Chinese Communist Party. We're talking about something like 92 million people, the leadership of China. Don't be surprised if you see travel restrictions or something like that, which have been talked about. Basically, escalating not just the rhetoric, but this attack on the leadership structure of China. And I think that's a possibility.
I want to go back to one of Ambassador Haas's older books. We're trying to sell them all here today. This was a movie you'll see at Memorial Day next year. Foreign Policy Begins at Home. Ambassador Haas, you never imagined a $4 or $5 trillion deficit. Granted, it's off a national disaster. How has our foreign policy, our projection to the world, changed with this new massive deficit?
Raises questions about American competence. It raises questions about the role of the dollar as the world's de facto currency, as its reserve currency. It potentially introduces elements of American vulnerability. This is all fine to run these deficits when interest rates are at historic lows. But even small movements up in interest rates would totally transform the American economic picture. What I think we've done here is we have introduced a potential source of vulnerability. Debt, Tom, is one of those things that it's fine until it's not. So in a sense, we're merrily going along, racking it up at record rates. And that will be fine until the day it's not. And that will be a real day of reckoning. But I do think it hastens the emergence of a world, not with a clear alternative to the dollar, but where the dollar loses the near monopoly it has on international transactions.
That'll be a conversation in the next hour. Ambassador, always fortunate to get you on the show. Appreciate your time this morning. Richard Haas of the Council on Foreign Relations. Tom Keene, I never thought I'd say this, that we'd come out of a crisis, or at least be working through one, with Europe looking good relative to the United States.
Well said.
And on the policy response, whether it's the pandemic or the fiscal response, that is what this is starting to look like. And I would caution, coming out of the last crisis, the last global crisis in 2007, 2008, Europe's bad response sowed the seeds of 10 years of underperformance. Let's be clear about that. It sowed the seeds for the next Eurozone debt crisis, and it planted the seeds for the next 8 years of underperforming versus the United States. And I think that's something we've got to pay a little bit more attention to. The data in the United States is looking soft, and most people expect it to continue to look soft. The data in Europe is looking better, and most people expect that trend to continue.
To that point, John, I would look for a reset this weekend of many of the investment houses as they look forward to the economic data. And they're going to fold in there, John, the stimulus debate in Washington, the overlay of the collapse of the Republican debate in Washington with the new economic trends we're seeing in high frequency data is really a grim picture. I'm not quite sure where we'll be on Monday.
I got a phone call last night from a guy from Boston with a gravelly voice, usually wears a bow tie, and he was very upset about a guy called Mookie Betts. Just devastated.
John, you can't. John, I may have to.
I'm going to need someone to explain. I'm going to need someone to explain that to me and to us.
You killed me yesterday with the un-American talk about the tots, and now you're going to kill me with Mr. Betts
coming up on a program.
Out to the Dodgers
and CEO of the Red Sox. Sam Kennedy joining us on the other side from New York City this morning. Good morning. This is Bloomberg Surveillance live on Bloomberg Radio and TV. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Bloomberg's learned that there is a settlement in that case involving Goldman Sachs and Malaysia's troubled wealth fund 1MDB. Malaysia would drop all criminal charges in exchange for $3.9 billion of reparations. That will include a $2.5 billion cash settlement and $1.4 billion of 1MDB assets being returned. In other news, it's getting more difficult to get a clear picture of the coronavirus pandemic here in the U.S. The problem, testing shortcomings. Health officials warn that new infections may be significantly undercounted. The government's testing czar told Fox News that while 67,000 new cases may be reported each day, the reality is more likely about 200,000. And resorts in the Caribbean are reopening to tourism, but not to Americans. Tropical vacation spots across the region are giving Americans the cold shoulder. Authorities are afraid they'll spread the coronavirus. This week, the Bahamas will begin barring commercial flights and passenger ships from the U.S. And there is a newcomer to the ranks of the 5 richest people in the world. Mukesh Ambani, chairman of India's Reliance Industries, according to the Bloomberg Billionaires Index. Ambani has a net worth of $77.4 billion. He just took over from Steve Ballmer for the 5th spot on the list. Reliance Industries stock is up 135% since March. Ambani's fortune has risen almost $19 billion this year. Global news 24 hours a day on Bloomberg. I'm Karina Mitchell.
Opportunity knocks at the door. Don't say, blimey, I've still got my pajamas on. Say yes to stuff and it will take you interesting places.
We're clearly going through some very unusual times and, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
this was that crisis, and that's what we delivered with a 15+% ROE. So I think it validates the strategy, but it's our strategy. It's not for everybody. This is what we chose. We didn't want to be credit heavy. We want to be flow-based, fee-based, asset-based.
I think that we have to all set examples. I think Major League Baseball is setting an example by, playing to empty stadiums, and so are other sports. You see that. Now, then they'll allow a certain number in. Well, the key is to get back to normal, because nobody wants to see this.
The President of the United States, as the baseball season commences, Tom Keene. Another button to Tom Keene's to press. Giancarlo Stanton last night,
Oh,
Tom.
you didn't notice that?
Just crushing one into left field. It was beautiful.
Douglas Cass down in Florida,
sure he let you know too.
that lofting judge on base as well. We won't mention Dr. Fauci throwing out the first pitch. I believe that was in Washington. But right now is really special, and really special for Bloomberg surveillance. It has been one of the great experiments, and I don't mean the Boston Red Sox back over the years. I still can't believe they won that pennant the first time. But the inspiration, John, to go British. Joining us, Sam Kennedy with the Boston Red Sox, and he was intimately involved, John, in the acquisition of a small football team in the United Kingdom. John, why don't you pick it up in celebration north of London?
Well, I can tell you, Sam, that having a Red Sox co-anchor fan, that is almost unbearable sometimes. Liverpool fans are equally as unbearable. They've had their moment. Sam, what an experience for all of you. Can you walk us through what you've learned with this experience in the United Kingdom with English football?
Well, we've learned a lot. We still have a lot more to learn. As you know, it is an incredibly global club with following like we've seen nowhere else. But congratulations to Jurgen Klopp and Michael Edwards, Billy Hogan, everyone at Liverpool that put this club back on top of the English Premier League. Quite an achievement, and we're very excited at Fenway Sports Group, and now we're hungry for more trophies, as they say.
Sam, how do you retain talent in Premier League? How do you retain talent in Major League Baseball?
Well, there's a common theme, and that is that we need to generate the resources on the business side to be able to go out and afford players, whether it's in global football or in Major League Baseball, and consistently reinvest our revenues back into our baseball operation, our football operation. That's been a 20-year strategy by John Henry, Tom Werner, and Mike Gordon, and that'll continue as long as these guys own and operate these different clubs. We've had our ups and downs. It is an exciting time right now for our organization, and excited to get going over here in the U.S. on the baseball side.
The dreaded Los Angeles Dodgers just unloaded a salary package to a baseball player. I forget his name. I'm sorry. But Sam, I mean, come on. There's a pandemic on. There's economic slowdown. You've got TV revenue issues. You're trying to get bodies in the stands. Everybody everywhere else but Fenway and maybe Wrigley Field. Have the Dodgers set up a new war of salary?
Well, congratulations to Mookie Betts. He's an amazing player, a great person. We're sorry to see him go with the dreaded Dodgers. I think it's a reflection, frankly, of what a great job the Dodgers have done managing their payroll. They put themselves in this position to be able to make this commitment. And if you're going to make a commitment like that, Mookie's a guy you want to do it with. We tried. That's on us. Unfortunately, we were not able to come to terms with him, but we do wish him well. We don't wish the Dodgers well, however.
Well, congratulations to all of baseball for starting a curtailed season yesterday, but it was sort of a disappointing game. The Nationals manager coming out and saying, it turned out long, let's just put it that way. We just have to put this one behind us. Do you think that baseball as an industry had a missed opportunity getting this off the ground earlier, given the fact that this is not a contact sport?
You know, I think we started right at the right time. Of course, you'd always love more baseball, but in terms of dealing with the virus and looking at the schedule and the calendar and the different markets and the surge and spikes in different areas, Commissioner Manfred just deserves a tip of the cap from the whole industry, as does Tony Clark, for coming together, and getting an agreement together to move forward on health and safety protocols. This is an experiment. It is a high wire act, to be sure, but the players are taking it seriously. We're taking it seriously in our facilities, and now we need to execute. And we have a really exciting brand of baseball, 60 games, and now an expanded postseason. It'll be great for baseball fans around the world.
Sam, you've got a relationship with legendary stadiums, Fenway Park, Anfield. They're going to be empty for the foreseeable future, and surely that changes the business. Where you spend money, where you cut money. Sam, talk me through that conversation now and what you're planning for. A season of no fans, 2 seasons of no fans. What does that look like?
Yeah, we're planning. We have our upside, our mid case, our low case. We have disaster scenarios. Again, a credit to our ownership group. They continue to invest in the product on the field. But in terms of our business, it is critical that we get fans back in the stands at some point as soon as it is safe and the government and health officials say we can do it, both at Anfield and at Fenway Park. For baseball, we rely on gate revenues, 50+% of our revenue. So as you can imagine, this has been devastating for the business, but the country needs sports, the country needs baseball, and we need to keep going through a pandemic. And flexibility is the order of the day. Everyone has shown a willingness to be flexible, and we'll keep doing that and readjusting our budgets and evaluating as we go forward. But what's important is we'll be back on the field tonight at Fenway Park.
Readjusting your budgets, that goes direct to some of the labor negotiations that hampered the beginning of this season. How much do you expect some of the players to accept cuts in their wages based on what we've seen so far this year?
Yeah, amazingly, the players have accepted the fact that we're only playing 37.5% of the games regular season, I believe, if we get going. So they're taking less wages. Everyone in the front office is taking less wages. It's everywhere. It's a reality across our country, across the world. It's a very difficult time. None of us have been through a pandemic. I hope we never see it again. And I hope that we get going into 2021. Knock on wood, hopefully a vaccine is around the corner. We'll keep our fingers crossed.
Sam Kennedy, it's your fault. Bring up the camera here. I'm doing my hands here. I'm standing outside the batter box doing Nomar Garciaparra. My son stood in Brookline, Sam, right off of Beacon Street and did the Nomar thing in the batter's box. How are you going to speed up the game? How are you going to speed up? It's Garciaparra's fault. How are you going to speed up the game?
Well, we need to keep working at it with the players. You can add things like a pitch timer, a pitch clock. You can limit mound visits. You can make rule changes. I agree with you. It's something that we need to do. We're at about 3 hours and 8 minutes.
Not good.
Yeah, it'd be great to get back in the 240, 245 range if at all possible. It's a priority for Commissioner Manfred and his team, and we'll work on it. But at this point, I think our fans and all of us are just excited to have baseball back, and we'll enjoy having live product, live content on television, on radio, on digital platforms. But I agree with you. We do want to speed up the game. It's a priority, especially as we look to connect with that next generation of fans.
Hey, Sam, great to catch up with you. Come back soon. I'll whisper it. Congratulations for Liverpool. Sam Kennedy of Boston Red Sox.
Guys.
Maybe they should buy the tots.
Hey, Tom, the good news for the people listening on radio is they couldn't see those hand signals.
They were dreadful.
Nomar Garciaparra showed up, the phenomenal shortstop, and he'd go in the batter's box, and then he'd step out, John, and he'd take his gloves and do this thing, okay? It's like what you do with Aussie Yen, you know?
What, I do with Aussie Yen?
Yeah, the gloves.
Coming up next, Chris Harvey, Wells Fargo Securities Head of Equity Strategy from New York City. Good morning. This is Bloomberg.
last 30 years, I've managed through a number of crises myself, but nothing I've ever seen has ever been quite like the crisis we have now. I want to talk to CEOs and see how they're living through this crisis. Who is going to really manage their company in a way that people will remember it? That's what I want to know. This is Leadership Live.
The China consumer has become so important to many U.S. brands and small businesses because that's where they see growth and the ability to benefit in the post-COVID environment.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
I think the V-shaped recovery is very hard to see with continued virus cases.
When we talk about a correction, at this point, we're talking about a normal amount of turbulence in the equity market, which would be about a 10% correction.
Fiscal stimulus is great, and it kind of gives us that shot in the arm, and it buys us time to get there.
That's what the U.S. economy needs. We're basically right at the edge of a huge fiscal cliff.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrell.
Okay, ladies and gentlemen, I closed position on euro at 116.04 buy. It will give us 200 pounds in profit. Okay, so this, you can see this position is closed.
Not having a deal before the weekend. You need some kind of agreement within Republicans before the weekend. We haven't seen it yet. We might not see it until Monday, Tom, and we want to see it. Not just the size difference between Republicans and Democrats. I've talked about that if it's just size, we can work something out. But if it's concepts, we've got to struggle. And I think we've got to struggle on enhanced unemployment benefits. And it's not just about the politics of them, Tom. It's about this economy. If this economy and the recovery is still constrained and people can't go back to work because these industries can't normalize, then you have got to have a trade-off. If you want to remove those enhanced unemployment benefits, here's the trade-off. You are going to have softer consumption through summer.
In big business, you see it earlier this week, Coca-Cola, the diminished revenues. Honeywell today, negative 18% organic revenue growth. That's a number you could never imagine. Lisa, the bond market moved yesterday on the Republican disappointment to lower yields.
Yeah, you see lower yields on the sovereign side, but in the corporate debt market, you actually saw yields tick a little bit higher, and this comes in tandem with the risk-off feel that we get today. There's a real confluence of events here. We also got the jobless claims yesterday. We really can't overlook that. The U.S. economy is stalling out, and this comes at a time of incredible policy uncertainty and rising U.S.-China tensions. Tom.
John, what are you focused into the weekend on? I mean, I'm just trying to get to the Sunday talk shows. You just wonder what the political message would be. What's the economic investment message, John, you're looking at for the real yield?
I think the most important question right now, building on what Lisa just said, going deeper into summer, are we losing momentum or going in reverse? Now, if we're just losing momentum and we can get some positive growth, some decent data in positive territory for the months to come, I think that might be sufficient for risk assets. If we're going in reverse, if this is the double dip that people feared, we've got a different problem.
And part of that, the linchpin here, as we hear in every conversation, folks, is the real yield. Look for John's show this weekend. But just as importantly, the real yield hinging off gold. And I'll give you that quote right now, $18.91 an ounce after a dash to 1900. We didn't get there earlier. Right now in the equity markets, for you to reset for the weekend and for you to reset into August, Christopher Harvey joins us. He's with Wells Fargo, head of equity strategy, where he writes a blindingly clear one-page note, not chatty, but smart, smart, smart. Chris Harvey, what's the distinction now of the equity markets that has your attention?
Well, what has our attention and what we've been talking about, and I hear all the negative, but really what we're talking about is the rate of change, and it's a story of the less bad stories. things are getting less bad. And you named a few companies, but what we're hearing, the chorus we're hearing is the worst is over. In the quarter, we've seen linear progression. And what I'm not hearing is I'm not hearing the fear in the commentary. I'm hearing people being conservative, but I'm not hearing the fear. And that's very constructive. And let's not forget, the equity market is up 4 to 5% month to date. We thought we'd have an equity market melt up. We think we're halfway there. And we're worried about a sell-off, not from these levels, but from higher levels.
That phrase, melt up. Chris, I know it's been a big theme for you coming into the month of July and going deeper into summer. What gives you the conviction that we're about to experience, we're halfway through a melt up?
Well, it's exactly what we were talking about. This story, now we're getting tangible evidence of the less bad story. In addition to that, you have interest rates basically at zero. Credit spreads are tight, funding markets are liquid, and people aren't positioned for it. And we think, yes, there are COVID hotspots, COVID situations in some areas, very difficult, but in 2 to 4 weeks, we think those hotspots are going to be much more lukewarm. And we think this is a pause. This is not, as you were talking about, this is not a reversal of the momentum. And we walk higher consequently.
Less bad being the key reason perhaps behind the lack of urgency that we're seeing in Washington, D.C. No deal going into the weekend. Mitch McConnell still trying to wrangle some of the Republicans behind him to get some sort of cohesive plan to expand the enhanced unemployment benefits. How much has policy backstopped this melt up, and how much does that melt up get stopped if we don't get some sort of extension here by the end of next week?
Lisa, the amount of accommodation on the table is, I'll use the word phenomenal. Whether it's monetary policy, whether it's fiscal policy, the Fed's balance sheet may be at $10 trillion by the end of the year. That is just hard to comprehend. Trillions of dollars in fiscal stimulus, that's amazing. So a significant amount of it is related to that. But really what happened is the machine, the gears in the machine, they seized up. And all the stimulus was liquidity to get it going. And now it's beginning to start. The answer to your question, hey, if we don't get additional stimulus, yes, it will impact the market. But there's more going on than just stimulus at this point in time.
Chris, how do you think this market's going to respond to data that shows signs of an economy stalling? How do you think investor behavior will shift around that? Not just how the data changes, how investors will behave as that data changes.
John, so the answer to that is always how bad. Obviously, the claims numbers, we took a step back. But we're in the middle of earnings season, and I think earnings and the commentary from the C-suite is much more important at this point in time because it's much more timely. And right now, that commentary is still pretty constructive. If, as we progress through earnings season, it gets less constructive or it turns negative, then I think we have a problem.
Well, Chris, we're hearing it. We hear it from the airlines. They're losing momentum. They're not going backwards. They're losing momentum. We heard it from the banks. They're worried about the back half. The recessionary forces are going to kick in again. Quite clearly, we made a lot of mistakes in this country on the Sun Belt. Opened too quickly, and we're paying for that. And my question for you would be, Chris, we're seeing signs of the administration change course. And I put this out on Twitter yesterday. I'll ask it of you. If the lost momentum of the economic data is born out of the mistakes made several months ago, will we trade on that? Or will we trade on an administration changing course?
Again, so we'll have to agree to disagree because we're seeing whether it's the FedEx's of the world, some of the transportation, others, we're seeing a pretty constructive course. Yes, there are situations where things aren't great. Getting back to your question, if we're going to lose momentum, it's going to be hard to get equities higher. I think really the biggest fear we have isn't in and around this. It's a negative rate scenario. You alluded to rates before a few minutes ago. Interest rates at 10-year continues to come down. The Fed is telling you they're giving you a financial eternity before they raise rates. That's a very difficult environment if you get that negative rate scenario for risk products. And I think that's the biggest fear for us. And that fear, I think, will materialize at some point in time because you can't get rates high. If you're telling the market we're not going to raise rates, eventually that negative rate scenario is going to come back, and it's going to be hard to price risk product in that environment. That's our biggest risk.
Another risk for markets that people are becoming increasingly concerned about is that the tech valuations have gotten ahead of themselves, and we're seeing this with the NASDAQ starting to underperform on a number of risk-off days. Today, we're seeing Intel shares down more than 13% after reporting a delay in some of their deliveries yesterday after the bell. I'm just wondering how much we're relying on tech to continue leading the charge upward from here in order for U.S. equities to melt up.
Right. So we think the rally is going to broaden out. we think that we're not losing momentum. This is just a pause. What we also think is people have taken a ruler and with tech companies, growth companies, and they just put that ruler down and drew that straight line up. We think that's wrong. And we want people to start taking profits from some of your Uber caps and from some of your momentum names and cycle it back into more economically sensitive names, because that's where we think the real mispricings are.
Okay.
But eventually, you have to have the rest of the economy and the rest of the stocks participate, which we think you will. I'm sorry.
So, Chris, on a Friday, buy the dip is in place. How do you know when to buy the dip? I mean, where in the dip do you step in and buy?
Well, we did tell people back in March below 2,500 to buy that dip.
Oh, that's not now.
that is not now.
He just wanted to slip that in there, Tom. Carry on, Chris.
It's really hard to call a 1% pullback a dip.
Thank you.
We would hope that you're fully invested at this point in time. And if you're not fully invested, this would not be a great time to really start buying your Uber caps and really put on a ton of risk at this juncture. We'd be a little bit more cautious. And one of the things we've been saying, if we do get that melt up, at some point we'll want to shift to a more defensive stance, to your bond proxies, to your low vol.
Chris, Scott Wren just fell off his chair in St. Louis with you calling a 1% pullback a buy the dip. I mean, John Farrell, this is where we are today.
I did not say that.
Hey, Chris, it's great to catch up. Chris Harvey there of Wells Fargo. Tom, what you just heard there from the South Side, you will never hear them talk about a trade that went wrong from 5 months ago. But you'll certainly hear them say a trade that went right from 5 months ago.
Well, that's okay. That's the nature of the beast. But, you know, folks, it's just amazing. And this is all just vectors, John. The vector's been straight up since time began. And, you know, it's just amazing, John, how we've removed ourselves from 10% correction, 18% bear market.
And Lisa, something that slipped under the radar this week, post-COVID tights on high yield.
Oh, listen to you guys.
5 percentage points on high yield. But Tom, I think it's important in credit right now. Lisa, credit remains still really, really supportive, even with what's happening with the data as we lose momentum, even with the jitters in the equity market. Into Wednesday, the tights post-COVID, 5 percentage points.
Yeah, and some people expecting that we could actually see record low yields on junk bonds. My question is, are we just worsening our situation on the other side of this pandemic, given the fact that companies are going to come out with much more indebted balance sheets?
But Lisa, don't you think this was a pain trade over in Europe for the last decade or so, that the ECB was just there on the bid, buying credit, buying credit, buying credit, and yields just kept coming in despite the fact that the economy wasn't looking great?
The Fed hasn't really bought that much corporate debt relative to the rally that we've seen. This has been investors piling in, and there is a big question whether investors have gotten ahead of what the Federal Reserve has or is willing to do, John.
Perception is almost everything. We saw this coming out of the Euro crisis with the whatever it takes speech from Mario Draghi. He did not have to buy a single bond, and yet yields on the periphery kept heading south. Coming up on this program, Bloomberg Chief Washington correspondent Kevin Cirilli on the latest down in D.C.
He's working Friday? Really?
He is working this Friday. The polls going the wrong way. He just got up an hour later, Tom. Give him a rest. From New York, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. Goldman Sachs has agreed to settle that long-running case involving Malaysia's 1MDB wealth fund. Goldman will come up with $3.9 billion in a combination of cash and 1MDB assets being returned. In exchange, Malaysia will drop all criminal charges. Malaysia has alleged that some of the money Goldman raised in bond sales ended up in fraudulent shell companies run by corrupt officials. China has struck back. It's ordered the U.S. to close its consulate in the southwestern city of Chengdu. That's in retaliation for the U.S. decision to close a Chinese consulate in Houston. Chengdu serves as a key U.S. listening post for developments in Tibet. China says its action is a legitimate and necessary response. Meanwhile, President Trump has given in to worries about the coronavirus. He's canceled his Florida nominating convention. That was going to be the biggest event of his re-election campaign. Florida just posted a record number of deaths from the pandemic. The president says he didn't want to take any chances. And it is the latest sign that the coronavirus is wreaking havoc in Hollywood. Disney has canceled the August release of the widely anticipated film Mulan. It's also delayed future Star Wars and Avatar movies by 1 year. Meanwhile, the largest U.S. theater owner, AMC, has delayed its reopening until mid to late August. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Much more to come.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Inflation goal is symmetric, which means we should overshoot it. We're having a difficult time doing that, like all developed economies. I'm supportive of the idea of letting inflation get above 2% before we take any action with respect to the Fed funds rate.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
President Trump has made very clear we need a strategy that protects the American economy and indeed our way of life. The free world must triumph over this new tyranny.
Secretary Mike Pompeo on tour, and he keeps swinging and swinging in the Chinese Communist Party. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, live on Bloomberg TV and radio. In your equity market, 1 hour, 12 minutes away from the cash open this Friday. Slightly firmer on the week, on a session down by a third on the S&P 500. The euro got a taste of 116 earlier in the week, liked it, came back for more. Wow. 116.08, back through that level, up a tenth of 1%. Yields higher by a single basis point to 0.58%. Dollar weakness, the story through the week. The focus now on Washington, D.C. On Washington specifically, Tom Keene. I got a message from a Bloomberg subscriber just moments ago sending me a video of Nomar. And all you had to say, Tom, was that he was playing with his baseball glove.
I did. I said his batting gloves.
But
right.
I didn't understand the hand signals, but now
They're
I get
not
it.
hand signals.
Now I
You
get
do
it.
like this, and they go, you know, this. On radio, folks.
I didn't want to do this, but we are going to do it. Did you see the Fauci pitch?
Yeah.
Yesterday, Tom.
Yeah, it was well done for a virologist.
It was pretty awkward. Let me just confirm it was pretty awkward. Tom.
Let me suggest, this is Dr. Fauci. We welcome all of you on Bloomberg Radio, particularly 106.1 Boston, 99.1 in Washington, as well as, you know, Dr. Fauci out there with a great symbolism of the pitch. And all I can say, John, is it's a lot farther to home plate and the strike zone than you think, even if you come in off the pitcher's mound. We forget how incredibly gifted these pitchers are in Major League and, for that matter, minor league baseball. We bring in someone who can get to home plate a lot better than Dr. Fauci right now. Kevin Cirilli, our Bloomberg chief nationals correspondent as well. I mean, it was great to see Kevin, but all of it was in the debris of a Republican Party and massive disarray. I love what Greg Valliere said today, that much of this redounds onto the Secretary of Treasury. What kind of Friday morning is Mr. Mnuchin having?
Well, I think that from the policy standpoint, I think that yesterday was a significant step forward, that Secretary Mnuchin was able to get to an agreement with Leader McConnell, and they have taken 2 points that I would add. First and foremost, a tiered approach in terms of targeting economic relief to individuals who need it in terms of a more stimulus coming in mid-August. But the second item here is these tax credits for businesses, particularly those who are able to hold on to employees who otherwise might have to be furloughed by the end of the year.
You sound like a Beltway guy. It's the 23rd or 24th, and we get through the weekend. I don't even know what date Monday is. Come on, Kevin, the clock is ticking. What is the urgency for Republicans to get their act together before the Sunday talk shows?
Well, hopefully they can execute better than Dr. Fauci throwing the baseball last night. But I think from a broader standpoint, they have to get this done within they want to get this done by next Friday. But in terms of where the conversation is with Democrats, there likely will be some more political theater. And I keep making this comparison, but I think it bears repeating here. This is what Washington does best. Anytime there's a government shutdown, they go right up to the middle and right up to the deadline, and then they kick the can down the road. That could be the situation right now. Before the August recess, there actually doesn't seem to be much urgency to get it done right around then. They could extend and work into recess, and that's something that I've heard from lower level staffers who, quite frankly, are already making plans and adjusting plans in preparation that might have to happen.
Kevin, I'll borrow your words. The President of the United States standing there, facing the camera alone, trying to take back control. Is this changing the direction of travel? Because the polls out in the last 24 hours, this from Fox, Biden topping the president in Michigan, Pennsylvania, Minnesota. This from Quinnipiac. In Florida, the president, 38%. Joe Biden, 51%. Can you round out the week for us, Kevin? Is it making a difference?
You know, it's resetting the palette. It's recleaning the palette in the sense that I spoke with a senior Republican yesterday, Jonathan, strategist, who advises the White House, who advises the re-election campaign and has for several years. And what this source told me was whether it's the president now embracing the use of masks or yesterday announcing that they will have a more pared down convention in Florida, that is all an example of the president trying to reset from what's been a very turbulent political past few months for his administration. But whether or not it's going to have a long-term effect, we just don't know. But this is a resetting this week for President Trump.
When it's a reset for President Trump, does that mean that there's going to be more unity or less unity among Republicans as they try to come up with some agreement and as they try to get reelected themselves?
You know, I think, Lisa, that from the standpoint of unity, Republicans are just as disunified as Democrats, to be quite frank with you, on economic issues. And while the president yesterday backing off in the short term from the payroll tax cut, he also essentially is embracing much more government spending than the base than the conservative ideological economic base of his party would like to see. So they have to iron this out. But as states have had to re-shut down and as states have had to really look at the data of an influx of cases, they've come to the realization, including conservative states, that more economic stimulus is not just needed, it was needed yesterday.
Kevin, in Ambassador Bolden's book, I think he referred to Secretary Mnuchin as a panda hugger. I don't think he would call Secretary Pompeo a panda hugger. This week, he has come out swinging against the Chinese Communist Party. What does Chengdu mean to this administration? Do they ignore it, go into the weekend and pretend this week never happened?
No, look, this was a largely expected move for Xi Jinping to close the U.S. consulate in Chengdu. It could have been more significant should they have closed the consulate in Hong Kong. But from a back and forth perspective, what happened with the U.S. deciding to close the consulate of China's in Houston, this was a back and forth. Yesterday, Secretary of State Mike Pompeo delivering, as you described, Jonathan, a blistering critique of U.S.-China relations over the last 50 years at President Nixon's presidential library. Remember that historic trip that President Nixon took in 1972, trying to open China to the world, trying to suggest that engaging with China would allow them to move in a more democratic, lowercase d there, democratic way of economic thinking and cultural thinking. Secretary Pompeo yesterday continuing with his tour, as he has for more than a year, quite frankly, in saying that that has been a colossal failure and that a new type of dealing with China is needed.
Kevin, great to catch up. Enjoy the weekend. Kevin Cerulli there, Bloomberg Chief Washington correspondent. Kevin called it blistering, Tom Keene. Here are the words from Secretary Pompeo. President Xi Jinping, quote, isn't destined to tyrannize inside and outside China forever unless we allow it. There's a message there, not just for the Chinese Communist Party, it's a message to allies. They're finally trying to get allies to come with them, and I just wonder, Tom, whether it's too late.
And as you mentioned earlier, John, the tour of the Secretary, the profound imagery of him giving this speech yesterday at the Nixon Library is just really, I can't say enough about the symbolism of that.
From New York City this morning, good morning to you all. Here's your price action this Friday morning. Equity futures rebounding from this morning's losses. Seen this a couple of times this week. China-US tension gap lower, then we bounce back. Equity futures down 11, off by 1/3 of 1%. Coming up next, former Labor Department Chief Economist Betsy Stevenson from New York. This is Bloomberg.
Quand on voit la mort de George Floyd, on image la mort de mon petit frère Adama Traoré. Et la France va dénoncer tout de suite ce qui va se passer aux États-Unis. Nous, dans le combat vérité-justice pour Adama, vraiment dans le court terme, ce qu'on attend et ce qu'on exige surtout, c'est la mise en examen des gendarmes, la condamnation des gendarmes et d'un procès public. Aujourd'hui, on dénonce le déni de justice qui est en France depuis 4 ans. Jamais, on ira jusqu'au bout, ça fait 4 ans que nous sommes là, nous n'avons pas peur. Ils ont les armes, nous sommes devenus des soldats malgré nous. Face à nous, c'est une machine de guerre qui n'a ni sentiment, ni état d'âme, ni remords. Oui, c'est un mouvement qui se prend, c'est le mouvement du comité Adama, de la nouvelle génération Adama. Aujourd'hui, moi je suis là, nous sommes là, on changera peut-être pas le monde du jour au lendemain, mais on changera des choses.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
From New York City, this is Bloomberg Surveillance for our audience worldwide. We're live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your price action this Friday morning shaping up as follows. Equity futures in the United States on the S&P down just 1/3 of 1%. The underperformance is coming from the NASDAQ. Some negative follow-through from big tech once again this morning. In the bond market, yields higher by a single basis point to 0.59%. And the euro, better PMIs out of the Eurozone. Are we expecting a similar theme in the United States? And the answer to that is not right now. Tom Keene, a shift in the last several weeks where economists are starting to look for a loss of momentum in the data. See it in the high-frequency stuff. Saw it in jobless claims yesterday. Will we see it in the payrolls report in a couple of weeks' time?
Makes for an interesting weekend reading here as all the houses recalibrate and readjust. What we're going to do right now, folks, and this is a joy, usually Betsy Stevenson of Michigan darkens the door on Jobs Day and it's rushed and we're worried about the derby of what happens at 8:30, but not today. We can speak to one of our leading policy analysts, Betsy Stevenson of Michigan, right now, of course, writing for Bloomberg Opinion and her work, of course, formerly with the Department of Labor. Professor Stevenson, good morning. John's got some very direct questions on the immediacy of where we are. I want to go to your Twitter feed. You have a brilliant retweet out on the fact that this is a nation that can bail out an airline. In this case, it happens to be Delta Airlines, not to cast aspersion there, versus what we spend on child care in this nation. How did that happen versus how Europe takes care of children?
Yeah, so first of all, let me just say I love Delta Airlines, so I don't mean to pick on them, but it does seem to me completely crazy that Congress cares more about saving one airline than the entire child care industry. And the problem is that in the United States, we still see child care as a personal problem. This is a women's issue, a personal problem.
Come on,
it's not.
Betsy,
It's an economic issue.
Even the fat cats like me, when the child has to go to nursery school, it's like writing a tuition check to Michigan. I mean, come on, it's out. Everybody watching this, everybody listening agrees this is a busted system. What is a Stevenson response to making our child care on the edge of Spain's?
Well, look, the thing is, we can't say, oh, we need to make it cheaper by paying child care workers less. You couldn't pay those folks any less than we already do. What we need to do is invest as a nation. We have a body of research that, we could stack as high as a building that tells us that investing in early childhood education reaps huge returns for taxpayers. And what people don't understand is if we let our early childhood learning and our child care systems erode during this pandemic, so they're not there for us when we come back.
Yep.
It's not just the parents who are going to suffer, but it's those kids who are going to suffer. We're going to have decades of pain that comes from not investing in these children.
Lisa, what Betsy is talking about
leaving their parents.
is so important. This is not just a problem for the people on the wrong end of it. It's not about mothers. It's not about people without a job who might miss their payments at the end of this month. It certainly is about them, but it's more than that. It's an economic problem more broadly. And Lisa, we always frame this as just the problem of the person experiencing it. And if we frame it as a broader problem for the economy, surely the collective will be there to do something about it.
The U.S. Census has started to try to quantify how big of a problem this is for the economy. And actually, they released a survey today showing that more than 8 million Americans were not in work over the past month because they had a child who was not in school or with childcare. And meanwhile, on the other side of that, Betsy, to your point, we have childcare centers closing at a very quick rate because they cannot stay in business, given the fact that they cannot care for people's children. What are you hoping to see to bridge this gap in the upcoming months, and how big of a hit could it be on the economy if we don't have something to remedy the situation?
So the permanent closures are the thing that I'm most worried about because they're not going to reopen. We're not going to get a vaccine and then the next day the brand new child care center pops open. So we have to keep those businesses going. We need to make sure that we're helping them do the investments they need to do to their infrastructure to make child care safe during the pandemic. And then we're going to have to make sure that those parents who aren't at work because they're staying home with a kid have a way to get back into the labor market. Our labor market, you think about the labor market as a highway, we have lots of off-ramps for parents, particularly for women, and we don't have very many on-ramps. And so we're going to have to be hitting this from every front, subsidizing childcare like crazy and helping the parents get back to work and making sure that the kids are getting that early childhood education. And I think we also need to start talking very directly about who really needs childcare in September versus who doesn't. I hear a lot of talk about what should open and what shouldn't open, but we're not prioritizing the kids and families who need it most. And it's time for us to start prioritizing. If we're not going to be able to do it for everybody, let's figure out who's going to be hurt most if we don't get them something.
Betsy, it's not clear the collective will down in Washington to address these huge issues is actually there right now. Another huge issue, the enhanced unemployment benefits that are set to expire month end. Betsy, let me ask this of you. Is there any evidence right now the enhanced benefits being offered are holding back labor supply?
I don't think that's quite the right question. What we have is a glut of labor supply right now. That's unemployment. We have a bunch of people who want jobs who can't get them. If you create a disincentive for some people to take those jobs, that just makes it easier for the people who want them to take them. So I don't think we have any evidence right now that these enhanced benefits are changing the number of people who are employed. That's the real question, right? And I don't think that if we continue to offer some kind of enhanced benefits right now, with unemployment as high as it is, with permanent layoffs happening every single day, continually happening, I don't think that our problem is that we're paying the unemployed too much. Paying the unemployed is actually what's keeping the economy going, because that's what's keeping demand stimulated, and that's what's keeping food on people's tables.
It's gave a massive lift to consumption over the last couple of months. It's undeniable. Betsy, the job number here on Wall Street is getting so difficult to read going into the next couple of weeks. Continuing claims suggest it might be okay. Initial jobless claims suggest a stall. The high-frequency data says things aren't great in many states across the Sun Belt. How do you view things right now?
Well, I do think that those claims data have been really hard to interpret. They certainly didn't predict the last jobs report, and I don't think they're necessarily going to tell us about this one. Look, what I see is ongoing permanent layoffs. These are not businesses temporarily shutting down, saying, look, we got to stay safe for a month and then I'm going to bring you back. These are businesses looking ahead at their revenue stream and saying, I can't afford this payroll over the next year. They're letting people go with no intention of bringing them back. And those permanent layoffs, those are the people who have a much harder time finding work again. So that's what I worry the most about. I also think that if you look back to what the reference week was, look, we're talking about the jobs report. We're talking about, the week that included July 12th. I thought a lot during that week. What's going on this week? And what I saw was new shutdowns happening in the Southwest. And I didn't see a lot of new reopenings. Basically, companies that were going to reopen, bring people back, restaurants, things like that, that had mostly happened by June. So I think we're going to see a negative number. I don't think it's going to be a big negative number, but I don't think we're going to see I don't think we're going to see enough people brought back from temporary layoff to offset the large numbers of people who are being permanently laid off right now.
Betsy, this raises a really important question. John's been talking about it this morning. Is this a deceleration of the recovery, or is this a reversal? Is this a double dip? And what you're talking about is the scope of the second wave, the second order of layoffs, enough to throw us into a double dip recession?
So I don't think of this as a double dip recession, right? I think that the data is confusing because temporary layoffs are not a real recession. The real recession comes when people stop spending money and we need to shed businesses, we need to shed workers because we're not bringing enough money in. I don't think we've fully seen the scope of our current recession. And what concerns me the most is I haven't seen any real recovery. What I saw was some businesses trying to reopen. Those businesses that reopened, they seem to not exactly be thriving. So I don't think that's necessarily a double dip, but I don't think we're at the bottom of this thing.
Professor, one final question. Lisa from New York emails in and says, could you ask the professor the profound effect of TikTok on the children of America? I mean, Professor, what do we do about TikTok?
You know, I have to say I myself enjoy Sarah Cooper on TikTok. And I do have, my children do seem to like TikTok, but I'm no expert in media consumption for children.
I think you just revealed your politics if people didn't know already anyway, Betsy. Fantastic to catch up with you. Sarah Cooper on TikTok. Betsy Stevenson there, a Bloomberg View columnist. Tom Keene, looking at that data for a couple of weeks' time for the jobless claims, we quite clearly saw that stall yesterday. In a few weeks' time, we'll get non-farm payrolls. The estimate right now, 1.9 million. We have very few contributors to that median estimate right now. But looking at Thomas Kosterg of Bank Pictet, negative 500K. That was his estimate put in just July 23rd.
I'm fascinated, John, the conversation you and I are going to have on Monday on this. I can't imagine what the different houses do to recalibrate as we go to August 7th. It's maybe the hardest call I've ever seen.
This has got to be one of the more complex payrolls calls, Lisa,
absolutely,
in quite a while.
Well, and it's not just the actual number, it's the type of layoff, right? It's the idea of permanent layoffs that are not going to come back so easily. And it's also the wage tier, right? Because initially it was the lower wage jobs that were getting cut. Now we're seeing the higher wage jobs. And this goes to the whole concept of what does business look like on the other side of this pandemic.
And that phrase that we hate on this program, Tom, right-sizing the business. It makes it sound nice and good. It's not. It's cutting jobs. It's firings. It's permanent layoffs.
Yeah, Matt Winkler, editor-in-chief, was great about this, John, years ago. I mean, I'd go mental about layoffs or, you know, the whole thing. It's not. It's called firings, and I really don't know which way that's going to cut here. But certainly, John, with the aircrafts, the airlines, the beleaguered industries leading the way, you wonder what the major generalized American business is going to do.
Those decisions piling up, and those decisions aren't pretty to watch pile up. In this equity market right now, we're down 0.4% on the S&P 500. On the NASDAQ, your underperformance is there once again. Big tech underperforming since a massive day on Monday, was it? Feels like a lifetime ago. Negative follow-through for NASDAQ futures. In the FX market, euro dollar enjoying a 116 handle, a 116.14. We're positive 0.1%. From New York, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. There is a settlement in that case involving Goldman Sachs and Malaysia's troubled wealth fund, 1MDB. Malaysia would drop all criminal charges in exchange for $3.9 billion of reparations. That would include a $2.5 billion cash settlement and $1.4 billion of 1MDB assets being returned. Meanwhile, China threatened to retaliate for the U.S. closing its consulate in Houston, and now it's done so. The U.S. has been told to shut its consulate in the southwestern city of Chengdu. It's a key U.S. listening post for developments in Tibet. Beijing says the move is a legitimate and necessary response to U.S. actions. And it is getting more difficult to get a clear picture of the coronavirus pandemic in the U.S. The problem, testing shortcomings. Health officials warn that new infections may be significantly undercounted. The government's testing czar told Fox News that while 67,000 new cases may be reported each day, the reality is more likely about 200,000. Resorts in the Caribbean are reopening to tourism, but not to Americans. Tropical vacation spots across the region are giving Americans the cold shoulder. Authorities are afraid they'll spread the coronavirus. This week, the Bahamas will begin barring commercial flights and passenger ships from the U.S. And there is a newcomer to the ranks of the 5 richest people in the world. It's Mukesh Ambani, chairman of India's Reliance Industries. According to the Bloomberg Billionaires Index, Ambani has a net worth of $77.4 billion. He just overtook Steve Ballmer for the 5th spot on the list. Reliance Industries stock is up 135% since March. Ambani's fortune has risen almost $19 billion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700.
You see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
None of us are safe until all of us are safe. We need to have a global approach into handling and fighting COVID-19, a global pandemic. Part of this, of course, finding an effective vaccine.
We cannot piecemeal this. This is, as you see, it has an integrity. It has a oneness about meeting the needs of the American people, defeating the virus as we honor our heroes and put money into the pockets of the American people.
How House Speaker Nancy Pelosi, we predicted it. Everybody did. Here it is, the tension between Democrats and Republicans trying to pass the next stimulus bill. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro, and your equity market futures down just a third of 1%. I'll step away, Tom Keene, as always, getting ready to count you down to the opening bell. Looking forward to catching up with a friend of the program, Mohammed Al-Arian.
Well, it'll be interesting to talk about the game theory of the moment on too many different levels. Right now, and this is a joy, there are people that dash through the government, and then there are people that actually do government. Mark Sobel has spent decades serving the United States of America on the side of Treasury. He's the guy who gets the fancy people ready for the big meetings, G7, G20, providing on international policy and international financial policy as well. We are thrilled that Mark Sobel could join us this morning. Mark, there's so many different ways to go here, but I really want to talk to you about the permanence of our foreign policy given the new unrest in Washington with deficits. Are we going to have a changed policy?
Well, thank you. I'm definitely honored to be here. I think November is going to be very important to seeing whether we stay on a more bilateralist track or we are more multilateralist in our outward orientation and building alliances to achieve our objectives, which clearly is going to be needed as the world's economic power and is more diffused throughout various continents.
I look here, Mr. Sobel, at the upset and the unrest now. You are truly our one voice over spanning decades of how we speak to the rest of the world on combined financial and political matters. How do we show up at the next G7, G8, G9, G20 meeting? What will be our strategy? Well, as you know, Tom, I am somebody who spent my life more working on the finance issues, not so much in the leaders track. I think that on the finance side, people have much in common. They know how to talk to each other. I think that the central bankers work extremely closely together. I think the central bank response to this crisis has been outstanding. I give them true credits. On the fiscal side, you saw that the United States, we always see gridlock, and yet we managed to come up with 3 bills so far. Another bill is absolutely essential. Germany abandoned its restrictive fiscal policies. So there are good national responses. I think that they were more national with less of a common framing than we had in the global financial crisis. Now, one point I've always made is that the emerging markets in the low-income countries don't have the safety nets or the backups that we have. They don't have huge government debt markets, and they can just issue treasury bills. So I think that we need to work harder with the IMF and the World Bank to tackle some of the debt issues that these countries are going to face. They're going to lose tourism revenues, remittances. They're going to take a huge economic hit on the revenues while they need to spend more on health and the like. So we need to step up support. The key G20 initiative this time has been the debt service suspension initiative.
Right.
It's not really, it's been very disappointing.
Mark, that's exactly where I wanted to go, given your experience with the International Monetary Fund and the reluctance on the part of the developed world to give to this fund to potentially cut the total debt load, the principal for emerging markets. How important is it for the global recovery, for developed markets to recover, for the emerging world to get its feet together, to get this sort of sense that they do have a backstop amid a deteriorating situation?
Well, I think one key factor, of course, is how will developed countries perform and to what extent can they take off. And that will be key. But I think another issue, as you've rightly highlighted, is providing financial assistance to these countries. Debt service suspension is one way. interestingly enough, that's only for low-income countries. Emerging markets, the same logic applies to them about the stresses, and yet there doesn't seem to be anything in place there. And then I think the crisis is going to push a lot of low-income countries and emerging markets into very severe debt distress through no fault of their own, but it's nonetheless going to be a hit. And I think that's going to require, as you suggested, some creative thinking on how to restructure and deal with debt. And tying it into Tom's question, I think that if the U.S. is inward and being bilateralist, and the U.S. and China are at loggerheads, well, the U.S. and China are the two world's biggest economies. China is the biggest official bilateral creditor. So how can the U.S. and China work together, if in no other realm in the economic and financial area, to provide some global leadership so we can tackle some of these challenges?
Mark, too short a visit. We'll have to do this again and soon. Mr. Sobels with the OMFI as their chairman. Thank you so much. Greatly appreciate it. Lisa, I want to go back to what you said, it seems hours ago, which is the bond market, IG and particularly high yield, has acted quite odd this week. Do we buy the dip in high yield bonds? Is that what the street does?
By the dip. You're talking about a 2 basis point move upward in yields as being a dip. I mean, this is barely a dip, and yet we do have investors coming out, Greg Peters, for example, of PGIM, saying that there's an incredible opportunity here because spreads can contract more given the Fed backstop. I really wonder, though, Tom, especially if we see this decelerating economy turn into a deepening recession, this idea that all of a sudden there is not just liquidity risk, you have solvency risk, and it is increasing for companies that have no revenue. And yes, they have plenty of debt, but there's only so long you can keep your lights on if you don't have any income, Tom.
And I'm glad you mentioned Greg Peters, because there were two really high points this week. One of them was a Greg Peters interview with PGIM. Lisa, as you mentioned, I thought Mr. Peters was brilliant. But the other high point of the week is you behaved yourself with Sam Kennedy of the Boston Red Sox. I got no rude Yankees garbage from you.
Well, I can't help myself. Look, I've got to be honest. I go to the Mets.
I know you go to the Mets. You didn't want to mention that on air, but they're the Mets.
There we go.
You've got a hard line to Steve Cohen to get those box seats.
Well, yeah, something like that. We'll see who the owner ends up being for the Mets at the end of this pandemic, Tom.
Full disclosure, folks, sightline at the Mets Stadium, Citi Field, are some of the best in baseball. Really, really quite good.
Pro tip.
Robert Swan, Intel. He's got a lot to explain. That's coming up. This is Bloomberg. Good morning.
Over the last 30 years, I've managed through a number of crises myself, but nothing I've ever seen has ever been quite like the crisis we have now. I want to talk to CEOs and see how they're living through this crisis. Who is going to really manage their company in a way that people will remember it? That's what I want to know. This is Leadership Live.
The China consumer has become so important to many U.S. brands and small businesses because that's where they see growth and the ability to benefit in the post-COVID environment.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
From New York City for our viewers worldwide, good morning, good morning. The countdown to the open starts right now. 30 minutes away from the opening bell with equity futures bouncing back. We begin with the big issue. The stimulus bill in Washington stalling with unemployment benefits expiring and the economy losing momentum. Senate Majority Leader Mitch McConnell now aiming for Monday.
The Senate Majority has assembled a framework for CARES 2. The administration has requested additional time to review the fine details, but we will be laying down this proposal early next week. We have an agreement in principle on the shape of the package.
Democratic leader Chuck Schumer applying pressure to Senate Republicans, saying, quote, "One of the reasons we're up against the cliff is the Republicans have dithered. The administration has no direction, no plan." Let's head down to Washington and catch up with Kevin Cirilli, Bloomberg Chief Washington correspondent. Good morning to you, Kevin. Going into Monday, what does this plan look like?
Well, let's dive into the details, because for families specifically who are looking for there to be some economic relief, they could get it by mid-August. According to the Trump-McConnell agreement, $1,200 checks for individuals who make $75,000 annually or $150,000 per couple. That includes an additional $500 for their dependent children. Meanwhile, the stimulus checks could be phased down for singles who earn up to $99,000 annually or $198,000 as a couple. So some much needed economic relief potentially on the way. That is just the baseline of what Republicans have agreed to in principle. Obviously, Democrats are asking for significantly more. They've already requested that it be 3 times as much more of a stimulus package than what the Republicans are calling for.
Kevin, this was never going to be smooth sailing. It was inevitable that at some point in discussions, we would have some tension. We have it, predictable, here it is. The polls, though, are going against the President of the United States. We had a Fox poll last night. Biden topping Trump in Michigan, Pennsylvania, Minnesota. We had a Quinnipiac poll as well. Looking at Florida, the president really lagging in that poll. The pressure of the polls, is it reaching this administration?
Yes, and quite honestly, the president's decision yesterday to pare down the Republican convention, which was supposed to be a lot of political fanfare in Florida, could actually impact sort of the free media that they could have earned locally in that key battleground state. But in terms of this economic moment that we find ourselves in, Jonathan, this potentially could be the last economic chance that the administration has to get out front in the economy. And so Speaker Pelosi and Democrats feel that they have the leverage, that they have the political capital in order to press for more additional funds because of those polls, but also because they feel that they have the upper hand in dealing with President Trump, not just in a matchup against Joe Biden, but in terms of the polls that suggest the frustration for how the administration has responded to this crisis.
Kevin Cirilli, Kevin, long weekend for you, I'm sure, still working. Kevin, great to catch up with you down in Washington, D.C. It is the area where the president has consistently performed well and held on. the economy, but the economy is showing signs of losing momentum. Mohamed El-Erian of Allianz and Bloomberg Opinion weighing in on the shape of the economic rebound and tweeting the following. Jobless claims have joined other high-frequency data in signaling a leveling off of the US economic recovery, from initial indications of a V to more of an asymmetrical square root sign. Mohamed, I'm pleased to say, joins us right now. Mohamed, we're always lucky to catch up with you, and what a moment as well. Here's the key question for me. Are we seeing signs of losing momentum or going backwards? Which one is it?
Good morning, John. I think it's losing momentum for now. And we're losing momentum for good reasons. People are engaging less, businesses are shutting down because health conditions have deteriorated. To go backwards, you need a major shock of some sort. It could be a policy mistake, it could be a market accident, but I don't think we're going backwards. I just think we're slowing down and we're going to level off in terms of the recovery. Just remember the square root, which I think is where we are right now in terms of economic activity.
Well, let's talk about the policy decision in front of us right now down in Washington. Mohamed, what would you consider a policy mistake as they put this bill together?
Underestimating the scale and scope. You and Kevin just had a really good discussion about relief. But if you look at what the economy needs, it's 4 buckets, John, not one. It is relief. It is making sure that we can live with COVID, because that's what we're going to do for a while, in a healthy and economically productive fashion. It is about countering downward pressure on long-term productivity. It's about countering downward pressure on household economic security. People are feeling insecure. Unless you move on all 4, we're going to have issues. So I think that the scale and scope is so complicated that at best we're going to have a partial solution, but they're going to need to go back to work pretty quickly.
Mohamed, the uncertainty is in this market right now. Gold approaching a record through 1900 for the first time since 2011. That's dropping across the Bloomberg terminal at the moment. Real yields deeply negative, a dollar that's breaking down, gold that's breaking out. Mohamed, could you weigh in on the market dynamic playing out before us?
Yeah, despite all that, John, the marketplace is comfortable buying every dip in risk assets. And the disconnect with the real economy, the disconnect with policies is getting bigger and bigger. But you've got to respect these technicals. They, at some point, are going to run out of steam. No one knows when. I, for one, was too cautious, and I acknowledge it, but I don't feel like re-engaging at these high valuation. But you've got to respect the technicals. This buy on dip mentality has become so deeply embedded that you really need a major shock to counter it.
Mohamed, if we do stall, if this recovery does go backwards, where's the risk in this market? Because the crowded areas of this market right now are the safer areas of this market. It's in investment grade, gold, which has performed terribly well through 2020 as well. These are crowded areas, in a lot of people's opinion, growth stocks in the United States as well, Mohamed. If you think there's a risk that we roll over, where's the risk in financial markets?
It's everywhere except if you're under the central bank umbrella. Unless you have a very big balance sheets behind you, there is a big risk of price gapping down. So it's everywhere, John. I wish I could say something different, but even the safe assets, even the names with very strong balance sheets have been taken to such high valuation that unless they're under the Fed umbrella, which is investment grade bond and certain high yield bonds, the downside is considerable at this point.
Looking at dollar yen this morning as well, a break of 107. We have been at 107 for the last 7 months. We're flirting with the 105 handle at 106.09. The dollar increasingly in focus here, Mohamed, and for a good reason as well. The dollar started to break down, and I'm wondering if the data breaks down, how the dollar responds to that, because typically if the United States is not doing well, the world's not doing well, and the dollar gets a bid, that haven play starts to come in a more powerful way. Do you think it will this time around, or is the reaction function of investors starting to develop in another way?
So it's tricky, John. You know, the number I look at every morning is the interest rate differential between the US and Germany. That's down to 104 basis points. Do you remember how high that used to be? It's come all the way down to 104 basis points because the US no longer dominates Europe in terms of economic outlook. And that is a major change. Europe is getting its act together. The US, unfortunately, is allowing health issues to contaminate the economy. So it is getting more complicated in terms of what it means for the dollar. I, for one, as you know, no longer believe that the US dominates Europe in terms of valuation. I used to for a long time. That has changed. And I'm not as comfortable about a dollar strengthening as I was earlier.
Where are you a bit more comfortable?
So, look, we've got to be very careful. Look at the Mexico number today. It has flown completely under the radar screen. But Mexican GDP in May contracted, economic activity contracted by 22.7%. What we are seeing now is the direct impact of COVID on the developing countries after they've had the indirect impact. So I think relative trades in this environment are a lot easier than absolute trades. There's clear differences in cycles, and that's not reflected in markets as yet.
Mohammed, it's always great to catch up with you. An important morning for us, and we appreciate you getting up early on the West Coast. Mohammed Al-Erin there on this market. In this market right now, gold through 1900 for the first time since 2011. Equity futures on the NASDAQ breaking down a little bit. Some interesting dynamics playing out in financial markets. Up next, Megan Green, senior fellow at the Harvard Kennedy School on the tension between the United States and China. From New York City this morning, good morning. This is Bloomberg.
When opportunity knocks at the door, don't say, blimey, I've still got my pajamas on. Say yes to stuff, and it will take you in interesting places.
We're clearly going through some very unusual times and, you know, enormous difficulties getting groups of people to agree on things.
From Bloomberg's European headquarters in the City of London, join us on Leaders with Lacqua.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
As COVID-19 halted the economy, retail investors turned to stocks, looking to gain on the market swings. We'll explore this trend on a Bloomberg special report, Markets Melt Up, this weekend on Bloomberg Television.
Speaking about China, the trade deal means less to me now than it did when I made it. When I made it, it was a great deal. But they're setting records. Yesterday was a record corn day. They purchased more corn than any order ever. And that went on for 2 or 3 days, and soybeans and all. But it just means much less to me.
It just means much less to me. The President of the United States addressing the trade deal between the United States and China, ramping up rhetoric after State Secretary Mike Pompeo delivered a warning saying, quote, when it comes to the Chinese Communist Party, I say we must distrust and verify. Freedom-loving nations of the world must induce China to change. If the free world doesn't, communist China will change us. Michael McKee, Bloomberg International economics and policy correspondent, joins us right now. Good morning to you, Mike.
Good morning, John. Some irony in what Mike Pompeo said, because he was basically framing this in terms of 2 Republican presidents who were in favor of globalization. Ronald Reagan, who said, trust but verify the Soviet Union. And Richard Nixon, he spoke at the Nixon Library. Nixon, of course, in '72 went to China and opened up that country. and Pompeo suggested that may have been a mistake. They've taken advantage of us. Anyway, the relationship continues to deteriorate in practical terms. So far, tit for tat, which may be about the best that anyone could hope for at this point. The Chinese announcing the U.S. now has 3 days to close its consulate in Chengdu, which is on the western side of China, after the U.S. ordered the Chinese to close their consulate in Houston. The administration hasn't given specific reasons, but members of Congress have suggested it is a spy center for the Chinese. The U.S. embassy, consulate in Chengdu, meanwhile, is the American headquarters for gathering information on Tibet and Xinjiang. Everybody basically spies out of their embassies and consulates, but the U.S. in effect saying what China did was a little bit too far. But given the proportional response from the Chinese so far, the practical effect is going to be very limited, particularly given the COVID virus has canceled travel between the countries, so neither side needs to be issuing visas to anybody. But what analysts and others are starting to worry about, and it may be creeping into the markets, is this is a ratcheting up of tensions that could hurt both sides. The Chinese stock market plunging overnight, down more than 4%. China's currency poised for its biggest weekly drop in 2 months after rallying for 3 straight weeks. Now, the concerns are balanced by reports China is still ordering U.S. soybeans, corn, you heard the president talk about it, and other products covered by the Phase 1 trade deal. Soy prices rebounding the last couple of days. This all may be bound up in politics as well. President Xi of China has to see if he can get reelected in an unprecedented move in 2022, a process that begins early. And of course, President Trump is locked in a battle to remain in power in the United States. Both sides may be playing to their bases at this point, John.
Mike, quite often, as you know, diplomacy is surgical, and it's often choreographed as well. When you make a move, you know what the next move from the other side's going to be. Did you get the sense this week that it was surgical and choreographed?
That seems to be the case, at least so far with the Chinese tit-for-tat retaliation. There was some talk that they would ramp that up. Some in the party calling for the Chinese to close or scale down the U.S. consulate in Hong Kong, which would have had a major effect on Americans who live and work in Hong Kong. But the Chinese keeping it somewhat proportional. Both sides may want to show they're tough on the other for political reasons without doing a lot of harm at this point.
Well, Kevin, the political reasons, or rather, Michael, the political reasons are pretty clear going into November. I'm used to speaking to Kevin about the politics, but Mike is right. The November election very much in focus. The president cancelling the GOP's upcoming convention in Florida amid surging new cases of the coronavirus.
I told my team it's time to cancel the Jacksonville, Florida component of the GOP convention. We won't do a big crowded convention per se. It's just not the right time for that. We didn't want to take any chances.
The announcement coming just as a new Quinnipiac poll shows former Vice President Joe Biden leading President Trump by double digits in Florida. Megan Green of the Harvard Kennedy School joins us right now. Megan, fantastic to catch up with you. The politics of November, how are you navigating them several months out?
Well, you know, as you point out, we're several months out, and so a lot can certainly happen, but I do think that a lot is coming down to sort of virus control, which has been a disaster in the U.S. and is starting to finally blow back on Trump. So we're seeing that in it, or his recognition of that, maybe in terms of him canceling the convention in Jacksonville and also restarting these daily briefings. So, you know, perhaps he's finally starting to see that the numbers. But, you know, the election's a long way away. A lot can happen, and there are big concerns about voter suppression as well. So if we had an election today, it would be much easier to call. But in November, I think we'd all be way too complacent to say that the results are clear.
Megan, it's not controversial to say that there have been many mistakes made in the United States on controlling and handling this pandemic and the reopening process as well. That gives birth to the data we're seeing at the moment, which is deteriorating. And my question over the last 24 hours, and I'd love to get your response to it, Megan, is whether we should be more worried about the data that has come about because of the mistakes made previously, or more constructive because we're changing course?
Well, you know, in terms of the virus data, I think we should be constructive. In terms of the economic data, though, I think we should be more concerned. And we should certainly be more concerned today when, you know, unemployment insurance benefits are going to phase out, the beefing up of them at least, at the end of the month. So where we are right now, I think we're facing this massive cash cliff that if Congress can't get together another fiscal stimulus package, there's a good chance we could go back into recession. And of course, that means we'd be back in recession before the election, which would have huge political implications. So in terms of, the number of new cases and coming down slightly in those states that have been worst affected in this sort of second half of the first wave, there are reasons to be, slightly optimistic, but we saw jobless claims were on the rise. A lot of these alternative data sources, like the New York Fed's weekly indicator, showed a dip for the first time on Thursday in a long time. The economic data isn't looking great, and of course, a lot of the PPP money is running out. If people don't get beefed up unemployment insurance, there's going to be a huge cash cliff. So I think we do need to be worried about the economy.
Well, let's talk about the economy then. The high-frequency data has stalled, maybe even rolling over. CEOs are talking about a loss of momentum. You mentioned the initial jobless claims, the improvement there has stalled. Continuing claims, though, came all the way in. Now, Megan, that data point is less timely, but this makes the jobs report in 2 weeks' time really unpredictable. And I expect to see a wide range of estimates. What's the best way of coming to some kind of conclusion to decide what the outcome of that payrolls report will look like, Megan?
Well, there already is a wide range of estimates with, economists predicting job gains and job losses. I actually fall in the latter camp for July. There is a new household pulse survey put out by the census that shows a cumulative loss of 7.6 million jobs between the reference weeks used for June and July jobs reports. And so that suggests that we might lose some jobs. And then if you just look at the PPP loans, even if the time to use them has been extended, the amount of money hasn't been extended. A lot of businesses have budgeted to keep people on payrolls for the original time period, which has already run out. So they're running out of money. And once that happens, they'll have to lay people off. So I actually think we'll end up seeing job losses in the July jobs report.
Megan, that is not a jobs report we want to see, if that's what we're going to experience. It's unbelievable to me, and I'm sure to you, coming out of this crisis, that Europe is looking so much better relative to the United States. We saw the PMIs out of Europe today. They continue to improve. Most people expect them to continue to improve. In the United States, we'll get PMIs in about 25 minutes. No idea whether the negativity of the last month in this country will be reflected in that. But I do wonder about something longer term, Megan. Coming out of the last financial crisis, the response planted the seeds for a recovery in the United States that really outperformed Europe. And Europe's response meant it lagged for the best part of 10 years. Are we seeing a similar dynamic coming together now?
So we're seeing a similar dynamic, maybe in the opposite direction, such that Europe is coming out of this faster. But, I think that Europe's faster recovery is all about virus management. The U.S. has been the poster child in how not to manage the virus. And, we can't really bet on our economic recovery until the virus is better under control. And so, I'm not sure the U.S. has a much more flexible economy in terms of labor markets in particular, but also in terms of product markets. And so that should bode well for a faster recovery, but it's just the virus management that has really been a headwind. And so, I don't think that we can make bets on kind of longer term prospects off the back of this. I think there's still a bunch of rigidities in a lot of Eurozone countries that will keep growth tepid for a long time. But for right now, the Eurozone's recovery is certainly stronger.
Megan, always enjoy catching up with you. Have a good weekend. Megan Green there of the Harvard Kennedy School. In this market right now, we've got equity futures breaking down 16 on the S&P 500. We're down around about 0.5%. Gold topping 1,900. Here's Bloomberg's Abigail Doolittle.
John, it's really pretty incredible. Gold now up for a 6th day in a row on the year, up more than 20%. And as you mentioned, topping $1,900 per troy ounce for the first time since 2011. Now, one thing that these two time periods have in common, back then it was all about Fed liquidity. Now it's all about Fed liquidity. So gold surging on the possibility of inflation at some point in the future. The question is whether or not it will take out its nominal high. The technical suggests it's possible, John. Right now, gold about 20% above its 200-day moving average, but back in 2011, 30% above its 200-day moving average. The RSI is surging. There may be more gains ahead for gold as investors perhaps anticipate the Fed is going to stay in place. John?
Abigail, thank you. We'll continue the conversation on this market. Up next on this program, the analyst action you need to know in our morning calls, and later, Erin Brown, PIMCO Multi-Asset Strategy Portfolio manager. That's coming just after the opening bell. 8 minutes away from that open this Friday morning. Good morning to you all. Equity futures breaking down a little bit to close out a week. We're down about 0.5%. This is Bloomberg.
The Nissan Ariya is the one that represents for the Nissan new chapter. I would say that the Nissan has a great experience because we have 10 years of the history through the Nissan Leaf. We have learned a lot of the voice from the customer.
5 minutes away from the opening bell, equity futures breaking down just a little bit on the S&P, down 0.5%, much more so on the NASDAQ. Big tech not doing well in the back half of this week, and we have some negative follow-through into Friday morning. We'll talk about that in just a moment. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Goldman upgrading JP Morgan to a buy, a 116 price target. The analyst saying it's well positioned to defend short-term returns and sustain its dividend over the next few quarters. Your second call from SunTrust, downgrading Hyatt Hotels to a sell, a $44 price target. The analyst now expecting a slower recovery in leisure travel due to the recent surge in COVID-19 cases. That stock is lower by 2%. And your third and final call from Barclays, downgrading Intel to underweight, $48 price target. The analyst seeing a lack of catalyst following the chip maker's warning of production delays. That stock getting hammered in the pre-market. We're down by 14%. Coming up next, previewing the big week for big tech and catching up with Aaron Brown of PIMCO from New York. This is Bloomberg.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
The tech trade starting to stall. That's the story going into the cash open this Friday morning. NASDAQ futures off by 1.24%. Equity futures on the S&P 500 off by 0.6%. Switch up the board in the bond market. Just stalling out a little bit in the last 24 hours. Initial jobless claims disappointing for the bond market. That means we stick in at around 0.6% at 0.59, up a single basis point. In foreign exchange, the euro got a taste of 116 earlier in the week, came back for more at 116.13. We're up a little more than 1/10%. And crude, a $41 handle, but that is not the headline of the commodity market. For that, let's get to the market desk. Here's Bloomberg's Abigail Little.
This morning is gold topping $1,900 per troy ounce for the first time since 2011, right now at 1906. The big question is whether or not it can take out its all-time nominal high at 1921. Technicals are strong. It suggests that could happen. And where we're also seeing strength in sympathy with gold, the gold miners. The gold miner ETF GDX is up about 40% this year, having its best year since 2016. It looks like investors really want in on what some think of as a haven asset and others think as a Fed liquidity derivative. Either way, lots of strength there. As for some of the movers on the morning on earnings, let's take a look there. Freeport-McMoRan, they actually have a small part of a gold mining business, but their bigger business is copper, down 2.1% despite posting a surprise profit. They missed sales slightly. The CEO said that the virus has changed the way that they will do business forever. However, they are cutting costs, and with copper mainly rising, the CEO is saying that could mean growth. But investors selling that today, perhaps in sympathy with copper, down on the day. As for Schlumberger, the oil company, up 1.3%. They posted a surprise profit as well. This may be costing jobs, or it does seem to be costing jobs. They have slashed jobs by more than 21,000. Royal Caribbean, not a surprise. Revenues plunged by 95%. And then finally, John, Intel, absolutely plunging, down 15%. That third quarter guide, just not enough. Stock getting punished here.
The tech looking weak this morning. Abigail, thank you. Around about 2 minutes into the session, the NASDAQ is off by 1.5%. The S&P 500 off by 0.7%. The risk rally more broadly breaking down. Looking at Europe, the equity benchmark in Frankfurt, Germany, the DAX off by 2 percentage points. Huge week coming up for big tech with numbers coming from Facebook, Apple and Amazon as well. Allianz's Mona Mahajan weighing in on the recent volatility within the sector.
All the big large cap tech names that we've all been watching due to report in the next couple weeks. What I will say, last week's dip in tech, where we did see the reopening story once again, very short-lived. Something to keep in mind as we move forward over the next few weeks.
That was Mona Mahajan on Big Tech. Let's cross over to Bloomberg's Kaylee Lyons. Big week coming up, Kaylee, and a big day right before us right now.
Yeah, that's absolutely right, John. We've really seen tech take a round trip this week alone. Remember, Monday, it was the best day for tech since all the way back in April, and now we look set for a weekly loss, the second consecutive weekly loss we've seen for the S&P 500 Information Technology Index in a row. It is down some 3.4% over the past 10 sessions. The reality hitting, John, that maybe tech companies aren't perfect, even if they are priced that way, because as we know, very lofty premiums have been placed on these tech names until recently, investors flooding to them for a kind of safe haven from the coronavirus story, willing to pay up for that perceived protection. Even if valuations have come off just a touch, the S&P 500 information technology sector still trading at an earnings multiple near 30 relative to the PE ratio of the broader market, which sits around closer to 24. But to put it in the words of my producer, Dan Curtis, with great multiples comes great responsibility, aka when you're trading at these levels, you better show up when it comes to earnings. The thing is, John, that just meeting or even exceeding expectations isn't proving to be enough. Expectations seem to have been so high that reports have failed to impress the bulls, even if they exceed on the top or bottom line. We saw that phenomenon play out with Microsoft yesterday. Fell hard despite posting better than expected revenue growth. Overall, about 20% of the tech sector has reported thus far, and on average, they have fallen about 1% after their results. Actually, the sector is turning out to be one of the earnings season's biggest losers. If you take a look at the performance of the major industry groups in the S&P 500 since June 14th, when banks kicked us off, tech is the second worst performing sector over that time span. We'll see if that narrative holds as we get the rest of the mega caps reporting next week, John.
Worst performing sector on the S&P 500 this morning as well. Kaylee, thank you. Shout out to the likes of Mike Wilson over at Morgan Stanley, to Julian Emmanuel at BTIG, who are looking for this weakness from big tech in earnings season. For big tech this week, the Nasdaq 100 down on the week by a little more than 2%. Could be the worst week going all the way back to March 20th. I'm sure that's a week many of you would like to forget. Joining us now is Erin Brown of PIMCO. Erin, short the dollar, get long utilities. You're sounding a little bit bearish here, Erin.
Yeah, I think that we're coming into a period, certainly seasonally, the month of August into September, even early October tend to be weaker from a seasonal perspective, but we're also seeing some risks start to percolate. The mobility data in the U.S. has started to slow. You've actually started to see that now have an impact on some of the economic data, with the city surprise index turning negative on a second derivative basis over the last week or so. We have an upcoming election as well, which is going to, I think, be quite heated and create uncertainty and volatility in markets. And then also you have the risk of a fiscal cliff at the end of this month, which also is bringing additional uncertainty to our market outlook. So I think in the very short term, over the next few months, from a tactical perspective, we've come very far, very fast, and I think it makes sense to rotate into a more defensive stance and positioning currently.
Erin, let's talk about how the dollar features in all of that. Typically, if the data breaks down, people would get cautious about global growth, and they'd be looking to get long the US dollar. You're looking to get short. That's a change in dynamic, isn't it?
It is, and I think it is. I think that's notable. I mean, you finally have started to see, from an interest rate differential perspective, the U.S. not screen as attractive on a relative basis versus other developed market currencies. I think it's important to note that we're getting long other DM relative to the U.S. We're not going long emerging market FX currently, and specifically within our positioning, we like euro, we like yen. We like strong current account surplus currencies that we think will do well, given the fact that, particularly with Europe's perspective, it is advancing, it is handling the virus better, and we think that the data could pick up on a relative basis versus the U.S. So while the U.S. may be slowing, we don't see those same trends emerging right now in Europe.
So, Erin, I think the yen call is really interesting because we're finally seeing dollar-yen break down. We have a 105 handle this morning at 105.95. For people that maybe don't follow the currency market in that particular currency pair very carefully, at the end of each month, going all the way back to February, we have closed the month with a 107 handle. What's starting to happen with the Japanese yen that couldn't happen over the last several months?
Well, I think the big thing right now that we're seeing is that you're seeing the spread between Japan and U.S. real yields continuing to widen, and you're seeing that relationship really break down, and that tends to be a good leading indicator for the currency as well. So I think that as long as you see interest rates continuing to widen, that spread differential continuing to widen, that should support flows into Japanese yen, which is what we're seeing, have been seeing over the last few weeks, and we think is really breaking down at the current moment.
It's playing into the gold trade as well. Gold at 19.05. Erin, you've talked about that rotation into the utilities in the equity market. Can you walk me through what you'd cut and why?
Sure. So we're really cutting the risk and cyclical risk in the U.S. As well as tech risk currently, just given how far it's come. You know, I know there's been a lot of discussion about tech this week, but remember, it's still up almost 20% on the year. And so from a tactical perspective, we think that it makes sense to take a little bit of risk off the table right now and get a little bit more defensive in the positions, rotating into high dividend yielding stocks, utilities, stocks that tend to do well in risk-off environments. But the focus of our risk-off right now tends to be in the U.S. because that's where we've been longest over really since March.
Erin, a really important conversation, and your thoughts reflected in this equity market this morning, that's for sure. Erin Brown of PIMCO. So my best to the team at PIMCO, Erin, thank you. Let's get to the market desk and talk about this price action. We break down for big tech. It continues through the week into Friday. Hey, Kaylee.
Hey, John, well, not just breaking down for big tech, breaking down for EVs as well. Theme for me today, EVs losing, shoes actually winning. The one shoe stock I really want to highlight is Skechers, which is up about 3% in the first few minutes of trading after a healthy second quarter beat, notably on gross margin, which came 5 full percentage points above analyst expectations. And a big standout number for you, John, e-commerce sales posting a 428% increase. Sell side very happy with that this morning. Interestingly, Steve Madden now flipping just about 0.5% into the red. It was initiated with a neutral rating over at UBS yesterday. $23 price target is trading just below that this morning. And then deeply in the red are these EV stocks. Tesla down another 9% after falling 5% in yesterday's session. That's despite beating expectations, posting a 4th consecutive quarterly profit after rallying nearly 300% so far this year. John, clearly that is just not enough, and that is weighing on Nikola as well this morning. John broke ground on its new electric truck factory in Arizona yesterday, but the question is, how is it going to pay for it? Will it have to raise more capital? We shall see, but that stock is lower by the better part of 9% early on, John.
Kelly Lyons, thank you very much. We're down 2% on the NASDAQ, off about 1% on the S&P 500. Equities on offer in the FX market. The yen is stronger. In the commodity market, the gold price is higher. In the bond market, though, the curve is just a little bit steeper today. On the bond market, a conversation you do not want to miss. Steve Major of HSBC up next, right here on Bloomberg TV.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
12 minutes into the session in the equity market this Friday morning, we break down on the equity market. Looking at the S&P 500 on the year, we are up. On the NASDAQ, we are up a lot. I'm not sure why we're looking at a one-year chart. Let's look at the intraday price action because we break down in the equity market on the S&P by 0.8, on the NASDAQ by 2%. With some sector price action, here's Bloomberg's Abigail Dillittle.
Well, it is relatively risk-off on a traditional basis. This year, of course, risk-off has meant that we have some of those tech movers and stay-at-home stocks on top. But today, it is traditionally risk-off, and that means that we actually have tech and consumer discretionary on bottom. Tech right now down 2.3% when we use the IMAP in the Bloomberg terminal. Really plunging on Intel, down 17%. Its worst day in 4 months on the third quarter guidance, that chip delay. Lots of those chip stocks down 5% or more. Up top, however, true defense, utilities up about 1%, really being boosted by yields. Energy is also higher, so a nice cyclical tilt there. On the week, a down week, and it's the reverse, or it's actually the same, John. Tech on bottom and utilities and energy up top.
Really interesting price action. Abigail, thank you. Tech breaking down. A lot of people were looking for that moment. We have it. I'm not sure you can say that the big tech earnings have been weak. You can say they disappointed relative to expectations, but we've certainly seen some massive numbers from the likes of Microsoft. Looking more broadly at this market right now, dollar-yen breaking down. To see some yen strength and break out of those tight ranges. As I said previously, we closed every single month going back to February with a 107 handle, finally at 105 on dollar-yen, 105.97, just short of 106. Levels we haven't seen going back to March on a sustainable basis. In the gold price, we see a record high through 1900 for the first time, going all the way back to 2011 at 18.99 right now. We're positive just 0.6%. Micah McKee, this started with the data yesterday, initial jobless claims, the economy showing signs of losing momentum. We've had the Eurozone PMIs. In about 30 seconds, we'll get the PMIs out of the States.
Yeah, the Eurozone PMIs come in fairly strong, all of them above 50 in Germany, France, and the Eurozone composite, suggesting there is widespread growth there. Of course, these are diffusion indexes. They don't tell you what kind of growth or how solid it's going to be, but it's a comparison to the prior month, and things are looking better there. Here in the United States, we started off the month in reasonable shape, and the numbers we're going to get in just a moment here are going to tell us more about the beginning of the month than where we are right now. One of the unfortunate things about this economy and the way things are going with COVID is it changes a lot, and the high-frequency numbers are more useful than some of the other numbers. We just got the market numbers in. Market manufacturing PMI comes in at 51.3. That's an increase from 49.8 in June. However, it's below the forecast of 52. The services PMI, a disappointment, still showing contraction, 49.6 from 47.9. So maybe a little bit of the decline in activity getting caught up in this first half of the month survey from the market folks. The composite PMI comes in right on the dividing line, 50 even, up from 47.9. So it shows that overall businesses see a little bit of improvement, but not a whole lot. The change in the PMIs from market for the United States, not as strong as we saw in Europe, John.
Mike, thank you. After seeing a long line of upside surprises, we see a series of downside surprises in the U.S. economy. Michael, thank you. HSBC's Steve Major seeing limited upside remaining in treasuries, writing the following: reduce our conviction to neutral on U.S. rates, with a view that the 10-year yield is likely to continue to trade in its recent 60 to 90 basis point range. Our lower for longer Fed view favors flattening position. Steve Major joins us right now. Steve, lucky to have you on a morning like this morning. Why have you adjusted your conviction on treasuries?
Well, we changed it at the recent asset allocation, but our year-end forecast is as it was, Jonathan. It's still at 50 basis points. And there's a tactic and there's a strategy here. We think yields are low for longer. We thought that for a long time. We are getting towards the bottom of the range. And so adding duration at this point is not a good idea because much of the rally has taken place. So our forecast is the same. It's still at 50 basis points. And I note that the consensus is close to 100 basis points. So that I've got no idea about. People seem to be looking for some kind of bounce in yields and rebound in the economy that's really unlikely.
Steve, if you're betting for a steeper curve, which you are not, are you betting against the Fed?
Well, that's an interesting one. The Fed probably wants to engineer the semblance of recovery, or at least the expectation of recovery. And strictly speaking, a steeper curve says things are going to be better. So if you were positioning for a steeper curve, you're kind of betting in the same direction as the Fed for things to be better in the future. But the paradox here is that things are a bit different. The Fed is trying to control yields at a low level because it knows it has to manage a low for longer kind of strategy along with the US Treasury. So both the government and the central bank need to manage this low for longer financial repression, if you like, for many years to come.
Well, Steve, how much longer is low for longer? And it's an important question to ask because, of course, it took a long, long time to get rates higher in the previous cycle. They've been conditioned by their experience in the jobs market previously that may make them hold on even longer this time around. When you say low for longer, what's the length of time you're thinking about at the moment, Steve?
Well, I've spoken of a decade of denial. That's looking backwards. We can refer to 20 years at zero in Japan. Let's just imagine that it's more like 10 years than 1 or 2 years. Now, it's a big call to make because things change. Who knows what kind of government we'll have in 5 years' time? Who knows whether central banks will be as independent today as they are in 5 years' time? But I imagine we should be talking in terms of decades, not years.
Decades, not years. So the 50 basis point call on the 10-year Treasury then, Steve, is not just a year-end call. It's something that you think we need to get used to for a long time.
Yeah, so in Japan, we've had zero rates for a long time. They've managed the 10-year close to zero through the last 4 years of yield curve control. The thing is that if the yield is around 60, as it is today, then that's equivalent to a weighted average of close to nothing, zero for a few years, for 5 years, and then above 1% for the following 5 years. That's all it's saying. And to me, that seems realistic. It's very difficult to imagine when and how the Fed's going to start hiking. Now, never say never, but we're looking many, many years into the future. And the Fed's own projections have got 2.5 for the longer run dot. That, to me, seems unreasonable, way too high. The likelihood is the Fed isn't hiking for many years to come.
Steve, nominal yields have been really, really sticky. Inflation expectations haven't been. We've seen this mild lift in them, and we've seen real yields come all the way in. In your recent research, you've spoken of distortions. Can you give me a better understanding of what you mean by that?
Yeah, so the yield curve looks like a hockey stick in the US, but that's only following the rest of the global bond market. So a hockey stick is flat at the front and then steep after some pivot point. In Japan, it's the 10-year. In Australia, it's the 3-year. In the US, the curve is scooping into the 5-year. So a hockey stick curve is a distortion. If you go and check your fixed income textbooks from university, you won't find these convex or hockey stick shaped curves. That's a low for longer building into the price. I'm also interested in tips. And if you look further out the curve, the real yield may have dipped below zero in the US at, say, minus 30 basis points or so. But look at it in Europe. It's hundreds of basis points below zero. So you could argue that with financial repression in place for many years to come, that long-dated tips could be a way to access that kind of outcome. So I like tips as an outright investment, both the inflation part and the real yield.
Steve, I could talk to you forever. Real yield's quite clearly playing a part in the gold rally, a big part in the last few months. I do want to finish on Europe. Bund yield's still aggressively low. You mentioned textbooks. There's nothing in there about negative 44 basis points on a German 10-year. We've had a big week for Europe. Do you have more conviction that Italy comes in tighter to Spain, to Germany, than you do German yields starting to trade higher anytime soon?
Europe looks in a good place compared to the US. That's because the tail risk is now less thanks to the recovery fund and the ECB doing everything it can, whatever it takes. Italy traded through 100 this week. I think it can go tighter to Germany. I doubt Bunds can get below minus 60, which is our forecast for year end. Minus 50 seems to be about fair, to tell you the truth. So the rally potential comes through the convergence. Now that's countries like Italy, Greece and Spain tightening in on Germany. And I think everything is in place. Europe compared to the US looks very interesting right now.
Steve, before I let you go, I give you such a hard time about your beloved football team. I've got to give you 30 seconds on your dear West Ham. West Ham looking okay, Steve, going into next season now. It looks like you've made it.
all of a sudden we can relax. And it would be nice to watch the last match of the season, not having to care who wins or loses. So 30 seconds is too long to talk about my team.
Well, Steve, you look well and you look relaxed, and I enjoy catching up with you. Steve Major, so my best to Bloomy as well. Some great research in the last couple of months from the whole of the team. Coming up on the programme, the market-moving events you need to be watching. That'll be next in our trading diary. The markets right now, we break down 2% on the Nasdaq, off by 0.8% on the S&P 500. Gold has had a bid through the morning. The Japanese yen getting in the mix as well. Dollar yen breaking down. Bit of risk aversion. Just not seeing it in the bond market, in Treasuries so much this morning. More to come from New York. This is Bloomberg.
You see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The national security bill was passed by Chinese lawmakers. The Hong Kong police force has already acted in accordance with the new law.
It's a very disturbing development.
This is, in effect, an attempt to end one country, two systems.
The central government is telling us just stay out of politics.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
25 minutes into the session, we break down, heading for the worst week on the Nasdaq, going all the way back to March. On the session, we're down 2%, and the S&P 500 off by 0.8%. Tech underperforms in the back half of this week. In the FX market, the yen outperforms, dollar yen breaking down. In the bond market, you just don't capture that risk-off tone in Treasuries. The yield curve actually steeper, your 10-year up a basis point to 0.58%. Gold through 1900 briefly for the first time going back to 2011. That's the price action. Here's your day and week ahead. Starting at the top of the hour, we get new home sales. House Speaker Nancy Pelosi speaking later, and the President delivering remarks at 3 p.m. Eastern. A fate